Well, welcome to the conference on rules for the lender of last resort. I'm Charles Calamiris, and Alan Meltzer and I are the organizers of this event. Thanks to the paper givers, the discussants, and the other attendees. And I don't want to take a lot of time, but I do want to perform one major function, which is to thank my co-organizer, Alan Meltzer, and introduce him. Of course, Alan needs no introduction as one of the sort of great men of monetary and finance economics of the last several decades. I won't say how many, Alan, but I will say that this whole project at the Hoover Institution, of course, owes its inception to Alan. And the way I would sort of describe that is, of course, Alan has made a career of understanding that public policy should satisfy many objectives, including effectiveness, independence, and accountability. Effectiveness meaning that it's coherent in its economic objectives, taking account of costs and benefits of policy actions. Accountability meaning that in a democracy it has to actually uh, be subject to democratic government rule. And independence meaning that its effectiveness and its accountability will depend on um, not being subject to the whims of the executive branch. And of course, what we learned from Alan and many others in the realm of monetary policy was that rules were essential. That is, if you're going to satisfy these objectives, as monetary economics has shown um, over the last 3 decades of development of monetary economics, the statement and adherence to some well-specified strategies, sometimes called rules, is essential to achieving those three objectives. And so when we sat down after Alan had sort of come up with the idea for this initiative, the broad initiative of regulation of the rule of law, we sat down to think about what our first few projects should be. It was absolutely clear, especially in light of the experience of the last financial crisis, where we were all sort of making things up as we went along, that it was useful to bring that same wisdom about the need for strategy thought out and enunciated in advance to be effective, independent, and accountable. That we wanted to bring that same sort of thinking to the subject of the lender of last resort. So I think of this conference as starting really from Alan's vision that this was a problem that needed to be addressed. And I hope that these 4 papers will make at least initial progress in that direction. So without any further ado, and a thank you, let me turn it over to Alan. Thanks, Alan.
Thank you, Charlie. The origin of this conference and the one that we held last month at Stanford on some issues involving constitutional issues is my belief that what we face is a crisis or a problem having to do with the rule of law. Regulation, I gave a talk. The origins of all this go back quite a few years. I was asked to give a talk at the on financial regulation at the Council on Foreign Relations in New York, and I, instead of talking about Dodd-Frank and such things, I talked about the fact that, in my opinion, regulation leads to crony capitalism, corruption, and circumvention. And to my surprise, the council being financed mainly by Wall Street, the first person who spoke up in the period after my talk said, "I'm a lawyer, I work on Wall Street. Who do you think shows them how to circumvent these laws?" Well, I wasn't going to argue with that because that reinforced what I had said, but it bothered me when I left to think that these are laws of the United States. I may not like those laws. There are a lot of laws that I don't like, but they're laws that are passed by Congress and approved by the president, and these people, and he sees his job as circumventing the law. So I began to think about how general is that problem? Very general. That led to this project, which is called at Hoover Regulation and the Rule of Law. we could write, it's not an anti-regulation program, it's a program to say, let's write regulations that maintain the rule of law. And Too Big to Fail is a great place to start at one end, because my learning over the long period of time that I've been working at these things is that we as economists have a responsibility to come up with reasonable, intelligent, economically sound rules for Too Big to Fail. And such rules would say, I believe, that the burden has to fall on the regulated, raise their intention, their interest in following the regulation by increasing their equity capital. If they have a lot of equity capital and they take the losses, there'll be fewer losses. What happens when we don't do that is that the regulators come with their own plans. And what we've seen is that in the things like the Dodd-Frank Act, we give most of the responsibility to the regulators. And the regulators are people who failed to anticipate, to act at the time of the crisis that helped that crisis to become a crisis. That crisis would have been smaller if they had not been able to forgive Bear Stearns, if they had been required equity capital. To close this off, let me just say that at a meeting that Jeff Lacker ran, the former chairman of the House Financial Services Committee said to me, Alan, how many years, how many dollars, how much equity capital did some of these banks have in 2006, 2007? He said, I didn't know. He said, 1%. 1%. How did they make their requirement? They made their requirement by having bonds, which they insured. So they had no skin in the game. They didn't care very much about the risks they were taking. That's a failure of regulation. That's the kind of thing that easily happens when we don't do what we should be doing, which is to come up with rules which give the incentives in the right place. That's what economics is about. That's what, in my opinion, regulation of financial institutions is about. And I'm happy to see that we have moved somewhat in that direction, although we still have risk adjustment in the measurements of these capital requirements, which is an obvious way to circumvent the capital standards, the equity capital standards. So with that, I'll begin by introducing Anjan, who is going to present his paper for 30 minutes.
All right, thank you, Alan. All right, so this is joint work with Viral Acharya. So let me, in the interest of time, get straight to the motivation. Okay, figure this out. All right. So this paper deals with prudential bank regulation. As we know, we have both microprudential and macroprudential bank regulation. Microprudential regulation deals with the issue of how we control risk at the individual bank level, and macroprudential regulation deals with controlling systemic risk. We tend to think of these two forms of regulation as being somewhat distinct, but recent events have shown that they're actually connected. All right, so since both micro and macroprudential regulations seek to enhance financial system stability, the natural question this raises is, what are the micro foundations that connect these two forms of regulation? Now, what we show in this paper is that not only are these two forms of regulation of banks related to each other, but that there may in fact be a fundamental tension between them. And one of the objectives of the paper is to highlight what this tension is and how regulators might deal with it. All right, so What do we mean by this? Now, there's a long-standing recognition in the literature that microprudential bank regulation requires what people have referred to as a belt and suspenders approach. So if you think about Basel II and the three pillars, we've got capital requirements, regulatory monitoring, and then this reliance on market discipline, which is really sub-debt discipline. And then people have recognized that even these three pillars may sometimes conflict with each other. Pillar one would seem to call for more equity and therefore less debt. Pillar three might actually imply that we might be better off relying on more bank debt and less equity. And then, of course, if you go in that direction, then it's also been recognized that you might, in fact, increase systemic fragility because you've got more highly levered banks that have less equity capital in them. Okay, so what do we mean by this? So I want to go back to what over the past 10 or 15 years in the literature has emerged as a somewhat schizophrenic view of leverage. And so you really have to think about what that means. On the one hand, uh, research has argued that having more highly levered banks leads to more bank liquidity, better asset choices, more discipline. On the other hand, we also recognize that having more highly levered banks means that we have more systemic fragility. And so once you introduce the idea of more systemic fragility, then of course it raises the possibility of government intervention in bailing out banks when the whole system is threatened. And so then the lines between micro and macroprudential regulation begin to get even more blurred. Okay. Okay, I must be, is this the best place to point it? It's kind of right now random in terms of when it succeeds. Okay. Um, all right, so, no. All right, so the main questions that this raises that we address in this paper are, first, what's the role of bank leverage relative to equity capital in affecting the bank's ex-ante liquidity and portfolio risk? How does maximizing ex-ante individual bank outcomes, and I'll make this more precise, affect ex-ante systemic risk? So how does the concern with microprudential regulation impact the outcomes that are relevant for macroprudential regulation? Is there in this setting a rationale for some kind of regulatory intervention? And if so, under what circumstances? And then fourth, how does this sort of intervention affect ex-ante outcomes, the incentives of banks, and then the unintended consequences that this leads to? And then once you recognize what these unintended consequences are, how should we think about designing ex-ante rules or regulations to deal with and minimize the distortions that these unintended consequences create? All right, so let me just give you, before I get to the formal model, because I may run out of time, is just give you a sketch of the model intuition for the results. So we have in the model an uninsured bank. We've got a manager who has, so think initially about just a single bank case. I'll introduce multiple banks. After that, the manager has some asset choice flexibility ex ante. He can also invest in some socially inefficient private benefit projects, so that's the source of moral hazard. There is some interim cash flows. We're going to have 3 dates, and at the interim date, there's a cash flow that's realized, but cash flows have some persistence in them. So a shortage of liquidity also contains information about insolvency, potential insolvency. The bank in this model can fail for one of two reasons. One is that its cash flow is too low and creditors step in and decide to liquidate it. The other is that some creditors receive some sort of information, either directly or noisily inferred through the actions of the creditors of other banks, that there's some impairment in asset values. And we have commonality in asset holdings, and then we decide to liquidate the bank because they think that the asset value is too low for it to be solvent. The bank's ex ante liquidity is the financing it can raise by issuing claims against its assets, against its terminal cash flow. And then both, unlike some other models, in this model, both debt and equity are going to discipline the bank, but in different ways. Okay? The way that debt provides discipline is through creditors' monitoring of project choice and the threat, sometimes just implied, sometimes actual, of liquidating the bank at this interim date. Equity basically provides incentives by conditioning the manager's incentive contract on the terminal cash flow and providing incentives to select the right project. All right, so in this model, the benefit of debt is this discipline and monitoring. So this is familiar. So this is what we call the first bright side of leverage. The cost of debt is that you can sometimes get inefficient, interim inefficient or ex post inefficient liquidations by creditors. So even though they have good ex ante incentive effects, after the fact, it's not a good thing. So this is what we call the first dark side of leverage at the bank level. And the bank's privately optimal capital structure trades off this benefit versus this cost. So the first main result in the paper is that the bank is going to choose some interior mix of debt and equity in its capital structure that balances these two forces. All right, then we introduce a multiple bank setting. In the simplest case, where you have two banks and they have common asset holdings, and they can suffer some interim systematic shock to asset values that can be either positive or negative. The bank's creditors may directly get this information, or they may infer it from the liquidations of other banks. So they can now liquidate either because they see that the cash flow is not high enough, or the asset value is impaired. Now, the key to the model, which gives rise to the contagion effects, is that not all creditors get this impairment signal. Some get, some don't. So there's some probability with which every creditor gets it. And so if I don't get the signal about my bank, I may actually infer something noisily by observing the liquidation of the other bank. Okay? But the inference is noisy. So any bank's liquidation is going to convey some information, albeit noisy, that asset values have been impaired, and that's why the creditors did what they did. This actually gives rise then to our second main result, which is that contagion effects arise in this multiple bank setting, and they induce systemic risk. The third result is that increasing ex ante bank liquidity by using more leverage at the bank level can actually increase systemic risk. Okay? And I'll tell you sort of the ways in which it does this. Okay? So this liquidation externality is what we call the second dark side of leverage. Okay? Now, we solve in this case for the bank's privately optimal capital structure with the systematic shock. And so the fourth main result is that in some circumstances, the bank's privately optimal leverage, and these are fairly reasonable circumstances, is higher than the socially optimal leverage, which then justifies a regulatory capital requirement to induce the bank to keep more capital than it would like to in its own self-interest. And then, so it's a leverage limit on banks. Also, because these liquidations are ex post inefficient, it creates an incentive, a temptation for the regulator to step in and actually bail some of these banks out to reduce these systematic failure costs. And we then focus on what the ex ante incentive effects of such regulatory actions might be. Okay. All right, so we consider three regulatory regimes. In the first one, the regulator never bails out. Okay, so question is, where do you set capital requirements when the regulator simply allows banks to fail but doesn't have an explicit bailout policy? The other is that the regulator decides to unconditionally bail out. So whenever the regulator sees banks failing, the regulator steps in, bails banks out. And then the third is conditional bailouts. So we allow for the regulator to actually get some more information on which bailouts can be conditioned. And we look at where the regulator would set capital requirements in all three cases and what effect this has on the ex ante liquidity created by the bank. Okay. Bailout is just paying off the creditors. So shareholders get wiped out, creditors get paid off. Oops. So let's consider the first regime, which is no bailouts. We show in this case that under reasonable conditions, the bank's privately optimal level of capital is going to be below the social optimum. And that's simply because no bank internalizes the contagion externality of its own leverage, which the regulator does. Okay? So you want to set minimum capital requirements to be higher than what the bank would like to set. In the second regime, which is unconditional bailouts, we have this result that once banks recognize that the regulator is going to protect all the creditors exposed, creditors have no incentive to expend any of their private resources to monitor or liquidate the banks, so there's no point in collecting signals, which means that all the discipline associated with leverage is lost. And now, actually, we, in an interesting way, get back to essentially Modigliani Miller. Debt and equity are no different. But all of the burden for providing incentives to the bank manager now fall on equity. And this actually diminishes liquidity ex ante. So this is sort of an illustration of Goodhart's law that if the regulator begins to use market signals, market discipline, to condition regulation on, then in effect you destroy the market discipline itself that was the source of that conditioning. In this case, socially optimal regulatory capital requirements are actually very high because leverage isn't serving any useful purpose. So there's no point in allowing banks to have any leverage. Then we consider the third regime, which we said, well, this is sort of very extreme to assume that the regulator doesn't know anything. So let's allow the regulator to collect some information. And so what we allow the regulator to observe is whether or not asset values are in fact impaired. And so now, when a bank is threatened with liquidation by its creditors, the regulator can tell whether this liquidation is because asset values have been impaired or it's just something idiosyncratic related to the bank having too low an interim cash flow. Now, actually, you get, not surprisingly, better results that the regulator now, to achieve ex-ante efficiency, comes up with a policy in which it pre-commits to only bailing out banks when asset values are systematically impaired, and to basically allow banks that are failing due to idiosyncratic cash flow reasons to fail. Okay? If you do this, then of course you completely eliminate any contagion because observing the failure of another bank conveys no useful information to the creditors of my bank. So they have no reason to condition liquidation of my bank on observing any market signals about the failures of other banks. And so by doing this, you can eliminate contagion. Okay. Okay. So that's sort of the setup. And then it turns out in this case, we show that you still have a reason for minimum regulatory capital requirements, but you can set capital requirements lower in this regime than you have to in the first regime when you decide not to bail anybody out. Okay? And that's because once you eliminate the contagion effect of debt, you've actually eliminated one of the dark sides of bank leverage. Okay? And so it permits capital requirements to be lower and it permits more ex-ante liquidity to be created. Oh, really? Okay. Okay, so we have watches that move at different speeds. Okay, all right. Let me then. I have like 15 minutes. Okay, so okay, then in that case, let me skip the formal model. Hopefully, I've conveyed the intuition. Let me get to. Okay, Alan, the equipment is not cooperating with you. Okay, no, all right. Let me go to. Okay, so let me just give you the timeline and then some policy implications. So what we have is at date zero, the bank needs liquidity from the financial markets for project financing. They can choose debt or equity. There is some debt face value that's set by the bank, so capital structure is optimally chosen. We assume all cash flows are legible. And the interim cash flow that I talked about is something that even if you have a weak cash flow problem, it's better to just pledge it to the creditors. Okay? And then the project throws off some interim cash flow X. It's observable only to the bank's managers, shareholders, and creditors. The bank manager makes a choice of the good versus the private benefit project after observing X. The creditor can expend some cost to discover the manager's project choice, and they can enforce a different project choice to liquidate the bank. and the regulator can step in and bail the bank out, provide liquidity ex post. And then at day two, everything pays off, okay, and the world comes to an end. Now, our first result is that if the interim cash flow is very, very low, so there's an investigation region, as you can see on that slide. The cash flow is really high. That means it's above the debt repayment. Then, of course, the creditors never investigate because they get fully paid off, and the bank goes on. If it's extremely low, they investigate, but they allow the bank to continue because they're better off waiting to be repaid than liquidating now. And it's in the middle that they actually end up liquidating the bank. Okay. Then we examine the case where there's no systematic shock, and as I told you, you get this optimal capital structure that I talked about. Now, the systematic shock creates this possibility of contagion, but here is the interesting part of this result, is that for any given bank, the likelihood of inefficient liquidation is increasing both in its own leverage and in the leverage of the other bank. And that's where this contagion liquidation externality comes from, because every bank takes into account the fact that if it increases its own leverage, it's going to be more likely to be liquidated, but it doesn't take into account the fact that increasing its own leverage also has an impact on the liquidation probability of the other bank. Okay. All right, so let me give you what the regulator's objective is, and then I'll close in about 2 minutes.
And I made a mistake and gave you too little time, so you have 5 more minutes.
5 more minutes. Thank you very much. Okay. All right, so then I'll speak a little bit slower. Okay. The effect of a regulator is, in this case, the objective is, so in the two bank case, it's the value of bank I plus the value of bank J minus the expected cost of bank failures minus the cost of regulatory action. So we assume that both the failures of banks as well as the cost of bailing out banks, that both of these are imposing costs that the regulator recognizes. And so the cost of bailing out N banks is C sub N, and then the cost of allowing small N banks to fail is big N sub N. So I'll show that to you. So in the first case, where the regulator never bails out banks, we show that the privately optimal leverage of each bank exceeds the socially optimal leverage when the probability of the systematic asset value shock is low, or the cost of the entire system melting down, both banks failing, is sufficiently large. So this is for the same intuition that I explained earlier, and then this rationalizes regulatory capital requirements. Oops. In the case of unconditional bailouts, as I mentioned before, we lose all debt discipline. All of the burden for disciplining the manager is through the incentive contract. You get less liquidity at the bank level, and there is still a minimum capital requirement. But this capital requirement is extremely high. In fact, it's extreme. There is no leverage that the regulator should allow the bank because it's not serving any useful purpose, but it's still creating the possibility of this inefficient liquidation. In the conditional bailout case, we assume that the regulator can learn what the asset value impairment shock is, but not the interim cash flow. And there, we allow the regulator to adopt this selective intervention policy where you only bail out banks when asset values are impaired and not otherwise. So no bank fails. By the way, this bailout has to be private, right? So you can't observe this, otherwise people can infer what happened. So you're essentially masking the fact that asset values have been impaired. Okay, and if it's an idiosyncratic liquidation, then you allow the bank to fail. So you can drive down the probability of contagion liquidations to zero. Now there'll still be the threat of liquidation, and there'll still be actual liquidations because of idiosyncratic reasons, but there won't be any contagion. Okay? All right. There is a capital requirement because the socially optimal level of capital is still higher than the private optimum. But the capital requirement is lower than in the first case where the regulator wasn't bailing out any banks, which means we get more liquidity when the regulator is willing to step in and prevent contagion than when the regulator simply stays out of the business of bailing out banks. Okay. So some policy implications. So what we show is that a blanket regulatory bailout policy can counterintuitively lower ex-ante bank liquidity. So even though you're infusing ex-post liquidity in the system, you're actually reducing ex-ante liquidity. And so the regulator in this case is some combination of FSOC and resolution authority that determines when to intervene when there is a bank failure. You can improve efficiency, this model shows, if the regulator generates private information about systematic shocks on its own, not just through the market. And the regulator has some rules. A commitment to let individual banks fail when it knows that systematic shocks are relatively mild, that the failure is more because of idiosyncratic reasons. And we have put in place leverage restrictions. So you have to have minimum capital requirements that are sufficiently high, but they have to be linked to whether or not you have a policy of ex-post bailouts. So they can't be independent of this bailout policy. And what the nature of that bailout policy is. Is it unconditional? Is it conditional? How much information is the regulator going to have? And then equity governance is improved to reduce reliance on debt discipline for liquidity creation. That would be a big step in the right direction. And we don't discuss in this paper how you might do it, but those have been discussed elsewhere. So to conclude, one of the key takeaways from this paper is that there is, in fact, a tension between microprudential and macroprudential regulation. Microprudential regulation focuses on, in part, the bright side of leverage, which is the market discipline you get, the higher ex-ante liquidity. Macroprudential regulation sort of focuses more on the dark side of leverage, which is the endogenous elevation of systemic risk and the use of regulations to limit leverage at the bank level, and then using regulation conditional on how much information the regulator has to bail out banks in some circumstances. Obviously, regulatory bailouts have these other consequences that we talk about, such as loss of creditor discipline and bailout costs. Okay. Thank you.
Thank you, Anjan. Just to add a small but perhaps important piece of empirical information. From 1929 to 1932, the worst period in banking history in the United States, not a single large New York bank failed. The minimum capital requirement, equity capital requirement in those years was 15%, some as high as 20%. They were prudent. Not only were they prudent in holding capital, but when President Hoover wanted to start something to prevent the crisis in banking, he met with them in Secretary Mellon's apartment in New York, and he asked the banks to put up $50 million each as a bailout fund to buy up loans which were being, or bonds which were being thrown on the market by the examiners. And the banks agreed to do that. Now, $50 million was a lot of money at that point, but they agreed to do it, provided the Fed, if they got into trouble, would allow them to discount their loans at the Fed. The Fed said no. So his effort at a private solution to the failure problem, in January, he started the Reconstruction Finance Corporation, which was the public solution to the problem. That just says, now, there's a lot of change in the world in the 80 years, so 15% may not be the right amount, but that's the amount that is written into, at my suggestion, into the Brown-Vitter bill, which is sitting in Congress, opposed by the banks. Doug Diamond is going to be the discussant. Doug?
Great, thank you very much. Quite a nice paper of Anjan's and Viral's. It's the second time I've discussed it. This is an interesting conference format where we had a pre-conference the end of January. So some of my first order comments are already incorporated here. Illustrates a very nice and interesting trade-off between the pluses and minuses of changing the way leverage works and changing the amount of leverage. So let me just start with sort of the big picture on how it works. So essentially, there's the control role of debt versus the costs of using more equity are the sort of two discipline or governance devices that are traded off here. In terms of the first thing, on keeping banks on the straight and narrow. The second thing, and this is new, a trade-off where the information that's produced by a failure that tells the other banks and the regulators and things like that can be actually a good thing or a bad thing for social welfare, but where you do need to allow the possibility the bank will fail to actually have any of the discipline control role of debt going on. So, obviously, if you don't let any bank ever fail ever, there's not going to be much control role of debt. But the trade-off is that failures themselves deliver new information. It's a highly nuanced and quite original way of thinking about the costs and benefits of intervening into bank failures. And there's a lot of stuff. I mean, a lot of the people in this room, almost anyone named Charlie or me or Raghu has thought about how debt has important control benefits. The way equity is modeled in here gives a nice framework for trading it off against other things. So that in terms of a set of ideas for organizing thoughts, there's a bunch of new stuff and interesting stuff going on here. So the thing that's new is this information content of bank failures. I'll describe it again. Anjan did a nice job describing it first time, but just sort of my point of view is that the information content of a bank failure is about macro aggregates, what they call a systemic impairment shock. And if you didn't allow the banks to fail and you did a private, unknown bailout, no one in the world would know about these macro shocks, and then that could be a source of either stability or instability, depending on what you want to use this information for. So there's a role of a regulator and a change from the last version of the paper. The last version of the paper, that regulator was called a lender of last resort. And sort of my view of the lender of last resort is that they're sort of not the first line bailout agency. And the whole point of being a lender of last resort is they're sort of trying to be relatively loss free, so taking relatively senior claims. So explicitly, this is sort of a bailout agency. This is sort of it's sort of like deposit insurance, potentially provided ex post on a discretionary basis. So these failures and bailouts in this model, in this approach, are because of fears about bank solvency, bank by bank solvency based on the macro conditions. There's no liquidity crisis or runs or panics or anything like that going on. So that's another reason this is quite distinct from the normal ideas people think about for lenders of last resort, because those issues are sort of front and center for those types of institutions. So then the debt versus equity trade-off, more debt here changes the probability of bank failure, and then bank failure is inefficient, at least potentially inefficient liquidation because of a standard thing sort of debt overhangs. The creditors get all of the liquidation proceeds, but only some of the risky continuation proceeds, so they're going to liquidate too often. And the other thing that can be changed in terms of governance is the amount of equity. And the trade-off here is that it's about equity compensation. The trade-off here of equity as an outside claim is not a big part of the model. Equity, there's something about dividends that makes equity not work very well here. But in terms of the trade-off, it's debt incentives versus equity compensation. And equity compensation is assumed to be inefficient and expensive, or at least expensive, because bank managers discount the future at an interest rate at a discount rate well above the interest rate. So if you defer pay for them in any way, even if it was a constant, you would never defer a constant in this case, you have to pay them more because of their high discount rate. So that's a very simple way of sort of trying to put a cost to incentives without getting into risk aversion and that kind of stuff. So then the role of debt holders and depositors is that they're in the unique role of being able to spend resources to monitor the lending choices of bankers. And if you set up these contracts right, they will have a credible threat of liquidation because they'll have the senior claim whenever they see the banker do the wrong thing. There's two choices here. And if they do the wrong thing, which is called taking the private benefit loan, think of like insider lending, but it could be risky lending. So the idea is that this is very like Calomiris and Kahn, if the depositors see the bank about to do the wrong thing, they threaten to liquidate. They go in and have a discussion, then with the manager then changes his or her mind and then undoes this. So the threat of a run is quite important. Uh, in addition, and this is sort of part of the dark side, they sometimes inefficiently liquidate just because they see that they can get more by getting out than continuing, and it's inefficient again because they have this senior claim, so they have an asymmetric payoff function. So then the information content of the bank runs or liquidations, again, as I said, I want to say it twice, it's very important. Runs reveal information about macro aggregates which impact the future value of this bank and, since it's macro, all banks. And since this information comes out, it's useful for all the other depositors in other banks to think about whether they should refuse to roll over their debt on those banks, causing those other banks to fail. And until we add some exogenous systemic costs, essentially you could say, if this information was really, really, really accurate, if you found out exactly what the macro conditions were, it'd be a good thing to kill all the other banks because they're worth more dead than alive. So the trade-off that's nuanced in this thing is if you release noisy information, which is bad enough to get excess liquidation, but not bad enough to get efficient liquidation, not precise enough to get efficient liquidation, then we can have some serious troubles. Okay, so I'll get some evaluation, just a little bit more reviewing the model. So new from the last version of the model is this exogenous cost, social cost of multiple bank failures. N, as a function of little n, the number of banks that fail, is increasing. The social cost is increasing. It's bad for one bank to fail, but it's worse for two banks to fail, worse per bank. And there's also a resource cost, C, of bailing out banks, which depends on n. It doesn't have to be increasing or decreasing, just positive. So and here is something that's actually important for the topic of this conference in terms of the need for rules here. It's assumed in this setup that it's never ex post optimal in terms of social costs, C plus n, to bail out one bank if it's in trouble, but it could be and it would be ex post socially optimal to bail them both out. So if that wasn't true, there'd be some interesting things we could talk about. So, but this is an add-on to the basic analysis, and sort of a lot of the reasons you want to have bailouts in the first place, if everybody's in trouble, come in right here. So this is sort of in terms of, some of the reasons that bailouts might be thought by some people to be good things ex post. Depends on this stuff, and this is sort of an essential part of the analysis, and I think this actually makes the analysis look more realistic than just the information stuff, which we already have. So again, the results before we get to values: complete bailouts all the time, every time, sort of like deposit insurance, removes the discipline role of debt, and then that would either without these bailout costs, these C and N costs I just talked about, that would say capital structure would be irrelevant. But because of C, the cost of actually bailing out a bank, you're basically going to bail them out all the time here, almost all the time. So therefore, you should have, since there's nothing good about debt, you shouldn't allow any of it. You should have 100% equity as a capital requirement because there's no upside to it, to the leverage. Absent any bailouts, private leverage could either be too high or too low, but it'll be too high when discipline from failure is not that important. If discipline from failure is very important, then actually the socially optimal level of leverage is above the privately optimal one, but I don't think there are too many people who would take that seriously. So bailouts only when there's a systemic shock provides the best of both worlds. You still get incentives, but you don't get contagion. So that would be that's sort of the like the nirvana case for bailouts. So evaluation of the important features, and we just talk about what I think what's good and what could be better in the model. So again, the idea that only depositors can monitor the bank, and given that they see something happening, they can go in and negotiate and intervene. That seems to me like I'm not sure that most depositors would work like that. That is sort of what's going on in Calomares and Kahn. But if you think about these are not sort of your typical depositors in a financial institution. So we got to really think about who are these guys who actually do this governance, and is there some way to think about institutionally setting up some private party that would have this kind of role? I don't think it's depositors per se. And so again, risky and implicitly short-term debt is the only way to deter these loans without costly incentive compensation. Are depositors the best monitors? Here they're assumed to know more than regulators or supervisors, and who know nothing, essentially, except that when the depositors tell them it. So if we think about this, that actually, in the U.S., it's very hard to find out what's in a bank's actual portfolio. So it's hard to imagine how this literally would go on if it's the depositors. In this model, whenever there's a run, it's in the collective interest of depositors. So there's no panics, there's no liquidity problems. I'm not sure that that's, I think putting that in would make this even more nuanced. There's a private negotiation between depositors and bankers. I don't think that makes, it's hard to think about how to do that as going. So if you could imagine giving some supervisors who knew something going on in the bank, you could imagine those regulations would go on. Maybe those negotiations could go on. Maybe you could think about a way of setting this up such that the regulators would be disciplined by the depositors, but maybe the supervisors would have some information of their own. So again, the main externality here is the information externality. There's no spillover through liquidity or anything. An individual bank chooses too much leverage because it doesn't take account of the fact that if when it fails, it'll tell people that macro conditions are bad, and that could cause contagion to other banks. That's like very, very, very different from the stuff that I've done or Charlie's have done. So I think that's actually a new idea. I think there's something important about this, and I think pushing that further, thinking about exactly how we'd evaluate that either empirically or think about its other implications, I think that's probably the most important thing to do next. So obviously, if you imagine that that bank failure is the only source of information, you got to ask what other information would there be? If there were financial markets or traded bank equity, that would actually reverse a lot of this. It would be hard to keep it secret that there was a macro shock. And if you can imagine you had something which they have, a bailout of depositors but not equity, then you can imagine that you wouldn't have Goodhart's law problem at all, because if there was going to be a bailout that didn't bail out the equity, and the equity would be written off, it would still be monotone in the state, and you'd be able to use bank equity prices as a source of information. Now, if you always bail them out, of course, that won't work. If you always bail out the equity holders too, that won't work. So interesting questions. How do you interpret regulators who secretly negotiate with informed depositors? That's sort of important. The run occurs. The regulators are going to bail out. They all keep it quiet. They bail them out, then no one knows. I think I'd like to see a little more meat on that. I think that's about the details. I think the basic approach will give you the same result. The details of how it's in the current model have some issues. And an interesting issue raised by this is we think about what kind of information should regulators and supervisors have. Should they have macro information, or should they have some bank-specific information? So if there's like insider lending going on, maybe you'd like the regulators to know there's insider lending going on. So if you said, I'm going to let them fail if and only if there's insider lending going on, then bank failures wouldn't have this bad inference that there must be a systemic shock. And again, it would monotonicity, it would actually be good news about, having a bank fail wouldn't be bad news about the economy. It would actually potentially be good news, and that could potentially get around the Goodhart's law non-monotonicity thing. So one last couple things. Absent the assumptions of this exogenous bailout costs, bailouts are going to need some kind of a rule, very much a rule of law, pretty much of what's going on in this conference. So the interesting assumption here is that it's good to bail out 2, but not good to bail out 1, basically makes it in the bank regulators' ex post interest to do the efficient thing. So do you want one guy's in trouble? Not a problem. He's probably misbehaving. Let's shoot him. They're both in trouble. It's probably a macro thing. Let's let him continue. That's good for governance. That is nice about it doesn't require any rules and commitment, because the ex post, these costs make the ex post thing go. Now, presumably you're going to say, well, it's sort of costly to let anybody fail if you have a discretionary regulator here, or if these C's and N's didn't line up like this sometime. I think thinking in this information environment how you set a rule for bailouts would be a good next thing to do. But this C and N thing is a nice way to get around it. Well, I guess I'm done talking because the clicker. Let's see the next slide. So can we learn anything about the lender of last resort from this? So this is explicitly not a model of lender of last resort. Suppose there are going to be bailouts, and there's a lender of last resort who's supposed to try to lend freely but not lose money. what's the interaction between these two things, and what's the role of stigma from borrowing from the lender of last resort when they're not potentially doing bailouts, but they might be the first line of defense against future bailouts? I think that would be a great question to ask in this thing. So interesting framework. It leads a little more motivation to actually be right in the lender of last resort policy rule discussion debate. But if you're thinking about the pluses and minuses of regulating leverage and how changing other regulations are going to affect that, all those trade-offs show up here. I haven't seen any other paper that ever got at any of those trade-offs. So I think anybody who's thinking about regulatory reform should incorporate the ideas in this paper. So it's a bunch of interesting stuff here. Thanks very much.
Thank you, Doug. All right, the floor is open for those who want to comment. Surely someone wants to comment. Yes, please.
For the idea of,
You want to say your name, please?
sorry, Krista Schwartz.
Thank you.
And I wonder if you could transfer this idea to, say, bailing out of countries in something like the Euro system, whereby you may end up with the same implications of bailing out, having a rule where you bail out more than one or just one, or letting it fail, and what does that do to incentives?
Yeah, so I hadn't quite thought about it that way, but I think, the key to the model in terms of creating this contagion possibility, there are a couple of assumptions that are important, right? One is common asset holdings. So if the failure of one bank is conveying information that's relevant for the creditors of another bank, and the other is that not all the creditors are actually getting information about that asset value impairment. So you can imagine that if we were talking about sovereign debt, if there were sort of common conditions and people knew that these conditions were common across a set of countries. So for example, this crisis, if you had smaller countries where most of the major banks were holding, subprime MBS, and people knew that, and then you had, one country go under because most of its major banks, so like Iceland or something, then you could potentially think about something like this with the creditors. At least it induces the creditors of the other country to sort of look more closely at the sovereign debt, and it could, if their signals are noisy, it could lead to ex post inefficient pressures or stresses that country experiences. So I think I can think in some circumstances of where these assumptions would plausibly extend to the sovereign debt scenario, maybe not in every circumstance.
Yes. No, go to the back room and then we'll go to Charlie.
Thanks. So I'd like to ask Doug, just to be a little clearer on one thing. I often find, and I don't mean to
Put your name down.
yes, Simon Johnson, MIT, and the Peterson Institute for International Economics. So, Doug, I often find that the Diamond-Dybvig model structures people's thinking, including my thinking, around a lot of these issues. And it goes. Your model goes straight, and it's a fantastic. The longevity, I think, of that framework is amazing and impressive. Questions that seem to that it helps you think about are: is this situation about solvency or liquidity? How would we know? Who's figuring that out? What's the base on which we make that assessment? And then, if we're putting in a safety net, because there are some legitimate liquidity moments, what are the distortions induced by that safety net? So I think it's a reasonable, and certainly I always find myself asking, what does a particular contribution add beyond Diamond-Dybvig? So if I have Diamond-Dybvig in my mind, and I really think that comes through in a lot of policy discussions and arguments, take different positions on it, what are we getting from Anjan's paper that we don't get from Diamond-Dybvig?
So that's a hard one. So in some sense, we're shutting down all the things about liquidity or the fact that these runs might not be even in the interest of the individual depositors. So so we're going to shut down. So it's going to get issues that are not up in Diamond-Dybvig at all. So, and in bailouts here, at least I should let Anjan actually answer. bailouts here, the reason that they're potentially good is to keep this information silent, to keep the information from coming out. So I think that is actually, it's a completely different set of issues. So the contagion and the externalities work through the information that is produced. And I think sort of the takeaway that I get is that if you think about bailouts, or lack of bailouts as being the only observable signal, that's going to say the type of information you want the regulator or whoever makes this discretionary decision to have needs to be fine-tuned so that it doesn't cause, when they actually do let somebody fail, it doesn't cause contagion, and that it causes the best possible incentives for the banks to be kept on the straight and narrow and not doing the risky stuff. So that's a different set of issues. So what are the regulators' incentives? That's this C plus N stuff. What are the regulators' incentives for a given set of information? Take that as given. What type of information should they have so that given those incentives, they can, without commitment, do the right thing? And then when we think about commitment, how can we play around with the incentives of regulators to make them do the right thing, giving them at least partial commitment, affecting their incentives? So it seems like that's a different set of issues. And one of my comments was that some of these things interact with the traditional run caused by run on other. The fact that guys are running on other banks could be because you think they have the same assets, or because that, gee, everybody's thinking other guys might be a good time to run. If they're thinking that way, so should I. Those are different issues, and I think they're both important. Is that?
Yeah, I think that's fair.
Actually, my comment was exactly following up and related to all this. And so the first thing that I would say about this issue of what kinds of shocks is this a model about is that it's a model about the shocks that give rise to banking crises. So I don't think that there's a shock out there that's not related to solvency risk that ever in the history of the world has created a banking crisis. But I do want to, in light of what Doug was saying, I do want to talk about just a couple of different things related to this sort of panic issue. So when we look at, let's say, the panics of the national banking era, they're particularly interesting because they were very disruptive, even in 1873, 1893, and 1907, leading to suspensions of convertibility in New York City. But the ex post, the actual insolvencies of the banking system were very small. Nonetheless, all of those panics happened at the beginnings of recessions when there was a spike in the liabilities of failed businesses and there was a preceding decline in the stock market. And after the suspensions, like the day after the suspensions, the cashier's checks of New York City banks trading against gold in New York City were trading at 99.7 cents to the dollar. So the interesting question is, why is it that a market for deposits would be one in which, when depositors' beliefs are that the risk that's associated with their debts are very small, they still run to get their money back when there's a slight elevation of default risk? So what I think the sort of point here is that money market instruments are risk intolerant. Now, the way that I usually explain this to my MBA students is I say to them, suppose I told you today that there's a 1/30th chance that your bank is going to fail and that you're going to lose 10% of your money if that happens. By the way, that's a fairly reasonable simulation of the national banking era, because your expected loss is 30 basis points, which is exactly what the pricing of those instruments was. I said, how many of you would, during your lunch hour, go get your money out of the bank? And the answer is all of them. So the point that's missing a little, and I'm not criticizing this paper for this, because not every paper can have every idea in it, but the point is that there are classes of securities that are relatively risk intolerant in the kind of Gorton-Holmstrom sense. And so that notion of having sort of risk intolerance and huge flows, even though there's a small increase in solvency risk, I think is part of the answer to Doug's question. That is, there's no such thing as an insolvency crisis versus a liquidity crisis. That is a misnomer. All crises in banking have to do with elevated insolvency risk. And some of them, like the Great Depression, were 3% of GDP of negative net worth of failed banks. And some, like the Panic of 1907, were 0%. But all of them had observable prior insolvency risk increases. And I think where the panic piece of it gets tricky is that we need this missing piece of understanding the risk intolerance aspect.
Yes. Oh, I'm sorry, is that Doug?
Yeah, I have something just on what Charlie just said. I agree with that. And I certainly agree that all financial crises and panics are about insolvency, but liquidity and solvency are jointly endogenous, and that's the whole point. So if all the assets were liquid in these banks, there'd be many, many, many fewer crises. And in fact, I mean, we all have like little nuanced versions of short-term debt runs as a discipline device. So you guys are, Charlie, and Anjan are on very similar things. That this is about having the depositors keep the bank on the straight and narrow. Raghu and I have this different view that basically you run first come, first serve, run prone deposits. So if there's any chance of any loss, you know you're going to get a run immediately. So it's a way of making it incentive compatible to generate a risk intolerant claim. So if there's any chance of any loss on depositors at all, uninsured depositors are going to run. 1/10 of 1% is good enough. Because if you're more than 1/10 of 1% of the deposits, if everybody else runs and you don't, you get nothing, and then you can do that recursively. So I actually think the fact that these things are so run prone and the fact that they are supposed to be very, very, very low risk are sort of two sides of the same coin. And then then these liquidity issues and the fact that runs may not be good for depositors as a whole has to be part of the discussion. So I basically agree, but I want to make clear that it's not like the bank's going to fail anyway. That's why there's a run. I don't think that's true.
See, the word that seems to be missing from this discussion as an outsider to most of this literature is uncertainty. The people who are running see the probability of loss as much greater than the chance that if they take their cash and hold on to it, they can redeposit it in full. And they just don't know what those probabilities are or what those risk assessments are. They are, in the sense of Keynes and Knight, uncertain. Or in the words of Secretary Rumsfeld, it's the uncertainties that are bothering them. That's what the run is.
Right. I completely agree.
Yes. Yes.
So, Stijn Klaassen from the Federal Reserve Board. I had one kind of more general comment, because you started out with interpreting this in light of micro versus macro prudential regulation, and I think it's very useful to bring in the ex post dimension, because most of that discussion has been about ex ante regulation. But I do want to ask you whether you have something to say about kind of what does this all do to the pro-cyclicality of the financial system if you're starting to introduce your ex post dimensions in it, because that's one of the worries about the macroprudential side, that we want to reduce the pro-cyclicality, and you bring in a new dimension in an exposed sense, and I'm not sure whether that's going to be a conflict in some sense. The more policy question is your interpretation of what kind of regime you would actually want for bailouts, and applying it to the US. So you have a very micro-prudential authority, the FDIC, but in your mind, you really, because you talk about macro shocks, that's not necessarily the best model. So I'm kind of looking for would you suggest then for that ex-post bailout agency, how should it be structured in terms of its remit, in terms of its objectives?
Right. So what we were thinking about is something that's kind of like a combination of FSOC and a resolution authority. So you need the regulator in this case in that regime 3, where the regulator is conditioning bailouts on having information about this systematic shock to asset values. And so the idea is that you need the regulator to not just rely on market signals, because that's what causes the difficulties that exist in regime 2 in our model, but to actually collect independent information. So if the regulator could get information about the systematic asset value impairment and then condition bailouts on that, then it's a superior outcome. Now, Doug made the point, well, if you have financial markets, they could also generate some of that information. Certainly, if you had banks which had CDS contracts trading on their debt, that's obviously going to produce information that's going to be valuable. The issue is any one set of creditors, given all of those market signals, may not have all of the information, and any regulatory intervention that's related to bailout, if you believe, and one can build a more complicated version of this model in which the regulator's actions or the actions of any group of creditors in liquidating a bank actually do convey some information, because I may be observing all the market signals that you are, but that doesn't mean that I can be sure I'm observing all the signals you are and that I have the same information that you do. So there's always the possibility that I could learn from the actions of another group of creditors. And as long as you have that, you're going to get these contagion effects. So then the issue is, what we need in our model with regime 3 is that the regulator can actually become as good as the creditors with respect to the systematic asset value shock. And if you can do that, then you can implement regime 3. Now, maybe the regulator can become just as good as the creditors themselves and also learn about the idiosyncratic shock. I don't think that's going to change any of the results. The procyclicality issue is interesting because we don't, in some sense, it's when the asset values are impaired that the regulator is stepping in. In the previous version of the model that Viral presented at Stanford, we had both the bright and the dark sides of leverage, and Doug referred to that in his discussion, which is sometimes it's actually good to let banks fail because asset values are so crappy that we should allow the system to melt down. But then in this version, we have de-emphasized that with these costs of massive failures of banks. So that one, the procyclicality issue, is something I have to think about, because we're talking about how do you set capital requirements taking into account the sort of the macro procyclicality and the effects of that. So that's something we need to reflect on. But so I don't have a ready answer to that.
This might be Jeff Lacker, Richmond Fed. This might be a bit tangential, but I think it relates to the theme of the conference. So the focus here is on bailouts and information revelation. I think that's very useful. And it has, in this model, it's information revelation about the fundamental at the bank level or, at the macro level. And there's a superficial sort of plausibility to this, a ring of truth about it, because I was listening to you and I was comparing this to sort of what I know about things that happened in the week. So in case of Bear Stearns, the discussion, the debate, which I wasn't a party of, but my understanding is the discussion focused on the choice and what the choice would imply about what creditors would do with other similar institutions like Lehman. And so there's this, so your story offers some interpretation of that. You might want to think about that. Okay. I know you didn't sell this, or at least here in the presentation, as a positive model of bailout strategy. But if you do and you go down that road, you're gonna have to deal with this sort of an alternative perspective. That similarly has to do with bailouts and information revelation. So that's one in which commitment is sort of incomplete and essentially discretionary. And what's at stake is what a bailout reveals about their likely bailout strategy with other institutions. And for me, that's the more compelling interpretation of what happened with Bear, that it was unclear whether we were going to bail out investment banks. And, we didn't have sort of a solid commitment to not to or to do it. and so not doing it would convince people we wouldn't bail out Lehman. Of course, doing it, we failed to bail out Lehman in any event. But that was, the information spillover, if you will, or contagion, was really about what people would infer about our bailout policy if we didn't. And so
Right.
I'm drawing this connection just to make that connection, sort of the rule of law and commitment. And in the circumstances given, the other good thing about this paper is the focus on the regulators' incentives, and I think that's critical and sort of under, maybe hasn't gotten as much attention in the literature as it deserves, but there you can see the dilemma. In the short run, it's always going to be easier to expand public perceptions about our likelihood to bail out in order just to get through the next couple of weeks without much turmoil. And that's seems to have been what has caused the safety net sort of to expand over the last 3 or 4 decades to the point where it's now 60% of financial sector liabilities that appear to be backed by either an explicit or implicit bailout.
Yeah, no, I mean, that's a great point. So what we did is we've made the bailout policy sort of time consistent here because of the costs and benefits. But I'm actually currently working on something, it's a separate paper, where we actually have a bailout policy that is ex post efficient for the regulator, but sort of ex ante inefficient. And so what you would really, so you get better outcomes if you can pre-commit not to bail out, but it's not time consistent. And then in that sort of a framework, you can even look at things like the regulator developing a reputation for toughness. And I think the Bear Stearns versus Lehman Brothers decision can perhaps, not everybody would agree with this, but it could at least be interpreted in that light. So now in this model, I think one can do that if you say, look, sometimes even though there isn't an asset value impairment shock that the regulator observes, so it's an idiosyncratic failure, but there is some regulatory ex post benefit, even though it's ex ante inefficient, to actually bail out even in the single bank case. So then you create this dissonance between ex ante and ex post efficiency. If you do that, then you sort of start getting into these interesting issues related to a regulator's incentives to develop a reputation for toughness. Because if you bail out a bank because of an idiosyncratic shock, which is not systematic, at least that bank knows that you've changed the rules ex post, and now that's going to have spillover consequences. And the creditors know, right? And that raises a whole host of issues. So it's just a question of sort of where we draw the boundaries. But I think that's a useful point for us to at least discuss in the paper.
I'd like to comment on one of the reasons for rules is to get some help with the problem, which is super powerful on federal agencies like the Federal Reserve, both in monetary policy and in regulatory policy, which is to overweight the very near-term problems which they so obviously face. And if they have a rule, they can try to look at the longer-term kinds of things which Anjan in his paper are talking about. And that's really one of the reasons we want rules. I mean, the pressures, I appreciate the pressures that come from the market, from Congress, from the public, to don't just stand there, do something, is overwhelming, and that's where we get into trouble. Let me say, one of the things that I find very attractive about this paper is that if we go back to Bagehot, the problem, the public goods problem, was systemic risk, that is runs. And that got converted into a problem of prevent banks from failing. Those are not the same thing. The public good is to protect the payment system. And that's what I see this paper as being about. That is protecting the payment system, which involves the public and the operation of the economy. And that a bank failure in a properly regulated system is no worse than the many failures that occur elsewhere, provided it doesn't set off the run that destroys the payment system. Further comment? Yes. Your name.
Mark Carey, Federal Reserve Board. So my grasp of the paper is a little weak, but it sounds like it's going to be important for the bailout authority, you said earlier, to get information about the, systematic value. I don't see how the system would work, in a basically repeated game situation. Because of course, in our legal system, there's going to be an audit of the bailout authority's actions ex post, and the only way the bailout authority can defend their actions is to reveal everything they've got about how they obtained the systematic signal, right? So then everybody's going to know that. There is either error in it or no error, but the bailout authority is going to have no advantage over the private sector thereafter, unless they somehow secretly reduce their error.
Yeah, so the idea is that, ours is not a multi-period model. So if you extend this to a dynamic setting, what I would have in mind is that these asset value shocks are not permanent. That they're, so you get a negative shock, then over time it sort of can become positive. So you need some volatility in asset values through time, that once you get hit with a shock, it can't be a shock that basically impairs asset values or enhances them forever. So as long as you have that, and as long as the public audit and the revelation of what the regulator knew is happening ex post, by that time, of course, the economy has moved on. So you need some time lag. It can't be contemporaneous, because then you can't keep it secret. So the idea is, if the bailout in this model is completely public, then it essentially serves no purpose, because even with this pre-commitment, it's essentially revealing that things are going badly. So you have to have some period during which there is some respite from information revelation. And then you do this bailout, and sort of it's a little bit like, back in the 80s with essentially the FDIC and FSLIC saying, if we can just ride out the storm and the yield curve is going to change, and mark to market is not going to be so damaging to asset value. So it's a question of, do you have enough time to weather the storm? So that's how I think of these shocks as transitory shocks, where transitory is defined by the period within the model. If I had multiple periods, then I would think of the dynamics, and then think about, how long a time should elapse before this information actually becomes public. Ex post, there is no problem with the regulator actually saying, look, this is what we found, and asset values were impaired. In fact, that is part of the common knowledge within the model, that everybody knows the regulator is going to do this. And in fact, it is the rule that the regulator abides by. But it's a rule that in this model is also time consistent.
So I guess it sort of pools together with the times when there's no news.
Exactly.
So, yeah.
Exactly.
Charlie?
I want to take the discussion about systemic risk one step further, which is, so this model is kind of taking it as exogenous, what the risks of the banks, the correlations and the risks of the banks are going to be. And now I'd like to just, let's think about reality for a minute. So in the U.S. banking system, if we were looking at national banks prior to the Federal Reserve Act, let's say in 1913, they were prohibited from having any real estate loan exposures. They did have some real estate loan exposures, about 1 or 2% of their loan portfolios, which were snuck in through the back door, but pretty much close to zero. And the argument for that was exactly that it was a bad idea to have the banking system involved in a correlated risk that was hard to liquidate during recessions. And so those things should be funded by insurance companies or capital markets. By the way, I think that was pretty smart. And now today, as of January 2008, roughly speaking, as I remember, about 70% of bank loans were in real estate. I'm putting aside mortgage-backed securities. Forget mortgage-backed securities. Just look at the on-balance sheet exposures of banks, 70% in real estate loans. That would have made a National Bank examiner in 1913 die of a stroke immediately if he had seen that, because it was so obviously a bad idea. And then, so then I'm thinking, well, from the standpoint of your model, let's not just stop at saying, oh, well, we want to make sure we only bail out systemic risks. Why don't we actually reduce systemic risks by moving real estate lending out of the banking system the way we used to? And so I'm going to tell you, having posed the question, what my answer is. Banks are encouraged, and in some cases forced, to engage in real estate lending as part of a political solution, despite the systemic risk that it creates, and that the bailouts are part of the political solution for supporting real estate lending. And so I think that to take your model one step further, we could say that it would be socially beneficial to take obviously correlated systemic risks and move them, to the extent that that isn't hugely socially costly to do, move them out of the banking system. And I would suggest the only reason that they're so big in the banking system, I won't say the only reason that they're in the banking system at all, but the only reason they're so big in the banking system is precisely because we want to put them there so that we can politically subsidize them. And in fact, bailouts are one of the subsidies. Absolutely. Correct.
Charlie, given the changing mix of national and state chartered banks, how important was the 1927 change which permitted the national banks to buy real estate loans where they had been prohibited before?
They were also allowed, the Federal Reserve Act was the first thing that allowed that in the door, because the farm interests were objecting to the Federal Reserve Act, and the way to get the Fed to be created was to allow a relaxation of the national banks lending into real estate. So I think, I mean, it's hard to say systemically, because you're right, the state banks were doing it before. But what I would say is insurance companies were the major lender, because they were sort of a natural lender in real estate. So I think, I don't have a good answer to your question, but my view is it was a political process. The Federal Reserve Act was really the beginning of it. And then, of course, if you look at the 20th century, it was federal land banks in the 19-teens, the Federal Reserve Act relaxing the barriers, then the creation of Fannie Mae in the 1930s, the FHA in the 1930s. And so the 20th century was really just a political, I don't know what to call it, mess of mixing systemic risk in banking. And so I was speaking at the FSOC conference, and I said, so the problem, of course, we have is I don't take FSOC seriously, because the Secretary of the Treasury is the head of FSOC. Now, the head of FSOC, what are the chances that he's going to call out Mel Watt, who he just helped appoint, for lowering the minimum down payment requirements for Fannie Mae purchase mortgages? We've now lowered them again to 3%. So that's obviously a systemic risk contributor, along with the huge real estate lending in the bank's portfolios. So can we trust the Secretary of the Treasury to be, through the FSOC and the OFR, to be our enforcer of limits on systemic risk? And I would say in your model, Anjan, the point is we want to put some hard barriers on, particularly on real estate exposure, because it is the business cycle and because it has those high liquidation costs. Would you go along with me on that?
Absolutely. I mean, one clear implication of the model, and I was taking notes when you were talking, is I hadn't thought about it from the sort of standpoint of intentionally introducing correlations across asset portfolios, but clearly if you could somehow reduce asset commonality across banks, then you don't need the bailouts ex post within the model to solve the contagion problem. And so, you kill more than one bird with one stone if you're willing to do it.
And related to that, I mean, Varal's paper, and then Jean Tirole and Fari, and then Raghu and I have this paper that essentially, if you have this policy, if you have too many to fail, you're going to bail them out. That directly gives them an incentive to take correlated risks.
Exactly.
If everybody's in trouble, nobody's in trouble.
Yeah.
So solves this time consistency problem and introduces that one.
No, exactly.
So the rules are really tough in this area. And on Charlie's thing on real estate, sort of that's got to, the real estate thing has got to be an alternative narrative here, because it can't be the case that it's a secret that real estate prices have fallen. So in that case, the secret, if that's what's going on, the secrecy thing is not.
I'm sorry. Remember Gary Gorton's discussion of the ABS market, and here's what I think was confusing or secretive. Nobody knew the size of the aggregate amount of bad mortgages, or what the factor loadings were, and we learned about that over time. Remember that Fannie and Freddie actually had to settle a case with the SEC, admitting that it was $2 trillion worth that they were exposed to, when in fact prior to the crisis they were claiming it was zero.
Right.
And so there was a revelation period where we learned about how big this stuff was. And my view has always been, if this stuff had only been a few $100 billion, then the implicit put option that Fannie and Freddie were giving to the market would have been enough to explain why Citibank and Lehman and others were willing to originate this bad stuff, because in bad states of the world. But what we learned in when the market opened and we started seeing the aggregate amount of this, as Gorton argued, we started seeing that this was a huge market. So I think there really was. You're right, Doug. The market knew what the prices were, but we didn't know was what the aggregate amount of the factor loading was. This paper is going to use the words lender of last resort in the same broad way as the previous paper. That is, I'm going to conceive of the lender of last resort as government assistance to the banking system. And I'm going to talk about the sense in which that's a very useful thing to do, because sometimes, I'll even say endogenously, that's going to take the form of collateralized lending. Sometimes that's going to take the form of guarantees. Sometimes that's going to take the form of recapitalization. And so I think one of the interesting things that we learned from the history of government assistance to banks is that there's always, in some sense, it's all the same. That is, there's always a shock that hits the banking system, and when the government assists, it has a similar motivation, which is preserving the financial system. But it's interesting that the mechanism that's chosen is often very different. That was one of the things that really got us started in this paper, which we call the Political Foundations of the Lender of Last Resort, a global historical narrative. In other words, we want to talk about everything. We want to talk about global, we want to talk about historical, and we want to talk about political. We want to try to understand, by combining those things, all of time, all of the world, and political determinants. We want to try to understand why the structures of government interventions to assist banks are so different over time and across banks. And so you're not going to get very far in this, obviously, if you take a narrow definition of the lender of last resort as collateralized lending, because, by the way, that is not generally how the lender of last resort, in the broad sense, operates. And I'm also going to even argue that that is not how it can operate under many circumstances, even economically. So we're going to have a mix of, so now you know the motivation, which is to try to understand these different incarnations of government assistance to banks, how they've evolved over time, how they're different across different countries, linking that, we're going to argue, to political foundations that are necessary for explaining it, and also mixing some economics of why these things have to be different sometimes with the politics. So it's a fairly ambitious paper, and also a very long one. So I appreciate it if you've gotten through all the way to the end, as I'm sure our discussant has. So here's a big picture summary of what we're going to do. So the first thing that we're going to do in talking about political foundations of this activity of government help of banks is we're going to talk about the original version of a Bagehot-style lender of last resort. And we want to talk about, particularly from the perspective of the UK, later Europe, and later even still the United States and other countries, we want to talk about the fact that this thing doesn't just come full-blown out of the brow of Zeus like Athena. This thing requires legal institutional prerequisites that themselves have to solve political problems before they can come into existence. So we're going to talk about the transition that occurs from the chartered banks of issue, which are private companies that are chartered in the 17th century, and what eventually evolves in the 19th century. In the UK, I'm going to even give you a date, 1833. All of the institutional dimensions are there so that we can talk about the Bank of England becoming a lender of last resort. And then, of course, that's a more evolutionary story about how it figures out what that role is, and some other things happen. Not everything happens in 1833, but you'll see my point. That is, we can date some very important institutional changes that were prerequisites, that you couldn't have had a lender of last resort in the Bagehot style until those had happened, and they couldn't happen without political foundation. So that's the first paper. It's really like 3 papers. That's the first one. The second one is to recognize that this is only one type of government assistance, or central bank assistance, or Treasury Department assistance, whatever you want to call it, for banking systems that we observed. And in particular, those other types, guarantees, capital injections into banks, they reflected 2 different things that I want to bring out. One of them is economic differences. So let me just be very clear about it. If you have a very big shock, such that the entire banking system is in a debt overhang situation, collateralized lending is not going to be a very effective tool. So there's some shocks. If the shock is sufficiently large, collateralized lending isn't going to work if you have a systemic goal. Guarantees and capital injections are going to maybe be useful in some other kinds of circumstances. So I'm going to talk about, as the nature of the economic shock changes, the mechanism of the assistance is going to generally be different. But more importantly, you might even say, there's some political dimensions to this. So if, for example, there is a political resistance to creating an authority that is going to act like a central bank, that's also going to put some limitations on the mechanism design here. One thing we're going to bring out here is that autocracies tend not to like to create central banks, for example. And so autocracies tend to have different kinds of ways of delivering assistance, and different kinds of likelihoods of giving assistance under different terms. So there are economic sort of limitations that explain why you get different structures of this, but there are also going to be political ones. Now, the third point that we're going to make is that when you look at the pre-World War II history of this activity, the broad lender of last resort assistance, what you see is that even though it's not, generally speaking, collateralized lending, and so you can't say that it follows Bagehot's rule, because how can it follow Bagehot's rule if it's not collateralized lending in the first place? Even though it doesn't follow Bagehot's rule, it does follow what we're going to call Bagehot's principles, pretty much, prior to World War II. And Bagehot's principles are going to be that you have a sort of tranching of risk, where you are going to take the least risk exposure you can to solve the systemic problem. That's kind of what the collateralized lending is an example of, right? That you try to lend against good collateral. You're still lending, so you're taking a senior position. You're not injecting equity right away at the first drop of a problem. And that same kind of principle of tranching risk and having the government try to take as little risk as it can while also solving the problem is, I think, really at the heart of Bagehot's rule, and I'm going to call that Bagehot's principles. And specifically, Bagehot never said that you're going to take zero risk. He wouldn't have, because that would have been stupid, and he was not a stupid man. But what he did try to do was derive rules in which the risk would be as limited as it could possibly be. And that, I think, is the principle that we are going to talk about happening in all of these different assistance programs prior to World War II. And crucially, connecting now with Alan's point, what all of these were willing to do was to watch individual financial institutions fail, which is also picking up on Anjan's presentation. What they were crucially all willing to do was to let individual institutions fail, but to craft mechanisms that were directed towards solving the systemic problem, following, as I said, this tranching of risk, this Bagehot principle, rather than just the Bagehot rule, because the mechanisms are more varied than collateralized lending. What's been interesting, though, is in watching that disappear, not just in the United States, but worldwide, because the reason it's disappeared is because we have created, contrary to the model of the first session, we've created effectively unconditional guarantees. That third policy approach that was in Anjan's paper that turns out to be inferior if you can make this distinction. Well, that turns out to have spread all over the world since World War II. It started in the United States and it spread in the 1970s pretty much throughout the world. And the problem there, of course, is that we have no longer this approach of what I'll call a disciplined lender of last resort. Now, of course, there's some interesting differences across countries, and one of the things that I'm going to talk about is the fact that that doesn't apply equally across all countries in the world today. And so then the final piece of our paper, which is, I think, in some sense the most ambitious piece, and it's still an incomplete piece, I'll explain that in just a second, is to look at legislation governing central bank behavior. We're going to, in this version of the paper, we only have 12 countries. So what we did was from 1970 through 2010, go through and try to characterize numerically the legislation governing central bank powers for 12 countries and talk about why they're different and look at correlates or covariates of those differences that are related to politics or to the financial system. And I think that that is, at least for the purposes of this draft, we have some interesting things to point to. We just discovered about 3 weeks ago, Luke Levin actually discovered, a new database that is going to allow us to expand this to more than 60 countries and go back even farther in time. So I don't think, and I want to say this before the discussant skewers me too much over it, I don't think that we have any statistically meaningful results there. We do have some interesting sort of observations about the 12 countries that I believe personally will turn out to be fairly robust. But we're going to eventually have a database of 60 countries and we'll be able to see whether these generalizations hold up. So I'm not going to bank on my ability to say too much about that today. Okay. First thing let's start off with is a little bit of history. The earliest version of government assistance to the banking system is in Rome in 33, not 1933, but actual 33, by Tiberius, when there's the first, what you might call global banking crisis, because Rome was, in some sense, from the standpoint as they knew, that was the global economy. And it's an interesting story. It starts with a political decision to enforce a long dormant usury law that causes a major credit crunch, and the decision by Tiberius is to open up the Roman treasury and to lend out at 0 interest for 3 years to all the Roman banks, and this basically brings an end to the crisis. So it's not collateralized as far as I know, and it certainly was at a very low interest rate, and it managed to solve the problem. Of course, we have in the early modern period, we have some examples of what you might call sort of proto-lender of last resort activity. Alexander Hamilton, the first U.S. financial crisis in 1792, even before we really have anything in place, it sort of cobbles together a lender of last resort assistance that you can read about in a paper by Dick Silla. And we have some interesting discussions of this. Henry Thornton, the French, I won't try to pronounce that, Caste-Comte, I think, might be the right way. There are some interesting examples of this. But what I want to sort of emphasize is that these are not what we're talking about as institutionalized central bank lender of last resort. And to do that through, as the Bank of England eventually does, is a political problem. Because imagine this for a second. We just lived through a crisis here. Imagine that we're going to give a financial institution the job and the duty of standing in the middle and solving a financial crisis. So we have to ask, by the way, the Bank of England was a private company until the 1940s, privately owned company. So how do you feel about putting a privately owned company into that position? First of all, does that privately owned company have adequacy of power? How in the world could it? Well, we'll figure that out. How does a privately owned company, based on its own capital footings, save everyone if it has to? Where does that power come from? And now you're going to politically vest it with that power. That's very interesting. Once you do that, as a political decision, you're going to have a burden to figure out how you also vest it with credible fairness and impartiality. You're creating this incredible power. How do you do that? And remember, Britain is a democracy, even at this time. How do you do that in a way that's politically viable? And then how do you create a balance of prudence? That is, that we're telling the bank it's going to do some things, but we want it to do things that sort of create the right balance, that aren't too stingy with government assistance so that we create unnecessary systemic problems, but that aren't too generous either, because as I'll probably won't get a chance to go into, there was a clear understanding that the Bank of England in its early history, when it was first using slender of last resort powers, partly as a result of deep politicization, was actually excessively generous. And so this was a learning process that I'm going to describe that's going on through a long period, I'll say roughly speaking, 1820s through the 1860s, where we're finally figuring out how to solve all of these problems. And it involves some explicit rules, but it also involves a lot of implicit rules. One of the things that's true about the Bank of England to this day is that its lender of last resort authority is not neither mandated in any clear sense, that is, there's no rule that says the Bank of England shall do this, this, and this, nor is it limited. And by the way, in that sense, it's clearly not a model from the standpoint of the motivations of this conference. One example is Forrest Cappy. I'm diverting a little, but I think it's still interesting. Forrest Cappy just wrote a history of the recent period of the Bank of England, and as part of that, he wanted to analyze the so-called lifeboat government interventions in the 1970s. But the Bank of England had destroyed all of the documents about that. And so there's no way for anyone to know what the Bank of England really did. What was the form of assistance, to whom, on what criteria? And that wasn't a coincidence. I would say, I know I'm on camera here and we're putting all this on the web, so I have to be careful not to say anything that I'm going to regret. But I would just say it wasn't a coincidence, and that it may even be possible to imagine that those records were destroyed in anticipation of someone looking at them. Just saying that's a possibility. So it is important to think within a democracy about this balancing between wanting to vest authority for discretion and wanting to create accountability, predictability that comes from some kind of rules and ex post monitoring. All right. So I'm not going to go through all this in great detail because I think you're going to see this pretty much self-evidently. But if you're going to set up a classic collateralized lending authority, you're going to have to solve those problems. And these are, we say, 5 key things that politically were done that were essential. Number one, you have to create the capacity. And the crucial thing here was to make the Bank of England's notes a legal tender. Because that meant that as long as the notes were receivable for payment of taxes, which is what a legal tender does, as long as they're receivable at par with specie for paying your taxes, then those notes have value beyond the footings of the Bank of England. That was crucial. And it was recognized. That was the purpose. And during the parliamentary debates, people said, and in case there's any doubt in the mind of the Bank of England, we expect them to use this power for that purpose, meaning as a lender of last resort. And furthermore, in case there's any further doubt about your accountability, that same law also made the Charter of the Bank of England revocable. And that was the same speech by the same person that said all of the things that I just said. So the accountability came with the privilege came with the accountability of, we're going to give you this vast power, which many people had recognized was potentially helpful. But we're also going to tell you, you better use it, but you better use it in a way that we're going to like. Furthermore, there was, as I just said, that second ingredient was the mandate. Speeches by parliamentarians explaining, as I just did, what they were doing, as well as making it clear that it was within the charter and a revocable charter to do this. The other problem, of course, was that England, until this same period, had a low usury law. It was 5%, 6%, I'm trying to remember exactly, it varied by date. But the point being that you couldn't do Bagehot's rule of lending on good collateral at a high rate, that's his word. You couldn't do that if you couldn't lend at a high rate. And so, again, it wasn't a coincidence that around this same time that we're getting rid of usury restrictions. The other problem, of course, is if you're the Bank of England and you have this legal tender power and you get to issue loans during a liquidity crisis, you might make a lot of money. Well, it's not a might. You did make a lot of money, because this is sort of a multiple equilibrium problem. If you flood the market, you actually resolve the crisis. And so before you provide your assistance, rates are really high. You provide your assistance, rates come down. You just made a lot of money. In fact, that was your power to be able to arbitrage that, right? That's what you have. And so, not surprisingly, while they relaxed constraints on the Bank of England, the Privy Council in particular relaxed the constraints having to do with the 100% specie backing for Bank of England notes during financial crises. That was their signal to the bank to now intervene. Okay, they didn't leave a lot of doubt. They signaled to them to do it, and then after the fact, there was basically windfall taking back the money that came from the ability to do that. So that was very important to create a perception ex ante of fairness. Now, of course, Charles Goodhart has quite correctly argued, and I'm not contradicting him in any way, that there was still some potential private-public incentive difference here. But clearly, part of the resolution of that private-public incentive difference was that the Bank of England didn't stand to profit on a windfall basis from its role as a lender of last resort, because it knew going into it that any extraordinary profits it made would be taxed. So it wasn't making its initiatives on a profit basis. So it was actually, this combination of powers was trying to create at least a public-spirited, if you like, organization, despite the fact that the power was vested in a private entity. Another interesting thing was the Bank of England creates its book, its rating book. And the point of its rating book is to make it clear that it's actually keeping track of whose names are on paper that's acceptable to the Bank of England. So this is a rule-based rather than a discretionary assistance program. So they had, as you probably know, the frosted glass. The frosted glass, you came up to have your paper discounted. You didn't know who was handing you the paper to discount. But you did know which names on the paper were acceptable for discount. But so that was a huge discretionary latitude. However, if there's a rating book policy in advance, then we have, in some sense, a commitment ex ante, because we've decided ex ante, we have an ongoing rating process of figuring out what an acceptable debtor is going to be. So I think you can see that, and I know I've taken a lot of time already just with this part, that this is a political problem, and it has to be solved with these kinds of tools, and that was exactly what they did. Okay, now going on to talk about the pre-World War II period in a little more detail, I just want to give a few examples of this. And especially in light of Alan's comment earlier, because Alan pointed out what the Hoover administration thought of doing with the banks in New York. Well, this was in some sense a replay of what the Bank of England had done in the Barings crisis in 1890. It was almost exactly, which was itself a replay of what the Banque de France had done in the Paris Bourse crisis of 1884. And this was also very similar, as I'll describe, to what was happening in a lot of different countries. Crisis comes along. Let's take the Bearing crisis. There's an investment bank that's overexposed itself to Argentine debt. And the commercial banks in London, the clearing banks of London, are worried because there's lack of information, Alan calls it uncertainty, about their exposures to Barings. Nobody knows which bank has which exposure to Barings. So the clearing banks say, we're very worried about the potential failure of Barings because nobody knows what our exposures are, and there might be a run on the banks because, as I said earlier today, when insolvency risk goes up even by a little, there can be massive flows of claims from the banks. And so the banks went to the Bank of England and said, why don't you do something to keep this from happening? And the Bank of England said, you go first. This is the tranching of risk. So the Bank of England said, you all put up a certain amount of money individually into a fund to be the first source of absorption of Barings losses, if there are any, and we'll stand behind that. Notice that's just like Bagehot's rule, but for a guarantee kind of program. But it has that same tranching. Now, other systems, Mexico and Russia, were autocracies. They didn't establish independent central banks. But they also used this same tranching, but to a much more limited degree. So, yes, I may take 6, but I won't take more, I promise. So let's talk about Porfirio Diaz in Mexico. So with the Panic of 1907 happens, Mexico is experiencing problems coming from the U.S., and so what do? They invent securitization. So Jose Limantour, the Treasury Minister, note there's no central bank, but the Treasury Minister says to the banks, put some of your loans into this fund. You, as a group, will retain junior claims on that. I, the government, will take middle claims on that, and we will sell, sort of like call it AAA super senior, in the global market. We'll sell the senior claims, and we'll get the liquidity that you need. In other words, they were on the gold standard. They wanted to keep market confidence in the gold standard, so they couldn't issue blank checks. It was an autocracy anyway, so not a very stable and reliable environment from the standpoint of the global markets. But as long as they kept the assistance limited in quantity, they could retain credibility in the international markets and actually use the international markets as the way they got liquidity. But it required the government to take some risk. They took the middling risk, making the banks take the junior risk as a collective. So that's again an illustration of those Bagehot principles, although the mechanisms are different depending on whether you're in an autocracy or a democracy. Finally, in the US, in the 1930s, we got a very severe shock because of all the problems of global deflation, Fed monetary policy, and there we have a debt overhang problem. And the government says, well, they're going to be, by the way, I didn't tell you about the banks that were allowed to fail in Russia, but they, trust me, it was the Bagehot principles not to bail out universally of all the banks. Not a blank check. The RFC, we say, look, we don't want to have the whole system have to collapse lending and payments. So what we want to do is we're going to do a triage operation. After March 1933, we shut down the banks, and now banks will either reopen or they won't reopen. They'll reopen. If they don't reopen, it's because they're hopelessly insolvent. If they reopen, they'll be of two kinds. They're not insolvent and they're in good shape. They don't need recapitalization assistance. They'll just reopen and that'll be the end of it. Or if they're marginal banks, they're sort of capital impaired, but they're not hopeless or necessarily insolvent, we're going to provide assistance through preferred stock purchases of the government from those. Now notice, the key role of preferred stock here is that it's superior, as they knew at the time, and this was the argument for using it. This is a very sophisticated finance argument. Well, the reason we need to use preferred stock is because if we did collateralized lending, we would subordinate the depositors and then just increase the risk of a run. Because the collateral, taking good collateral from the banks, would make the depositors worry about their positions with the residual assets. So that was a perfectly sound argument, and we talk about why it was done in a disciplined way, not just ex ante based on screening, by the way, as all those other interventions I talked about were, but also in the sense that They also required monitoring, RFC officials on the boards of directors of banks, and very importantly, limiting dividend payments by these banks and requiring the banks to recapitalize. Okay, so I just have a minute or two, and I'm going to talk very briefly about what happened in the post-World War II period. And, roughly speaking, what happened was, I would say for political reasons, call it cronyism meets populism as a theory of bank bailout policies. We get very politically popular across the board sort of deposit insurance broad-based bailout policies, which were not, I would argue, a good idea, but were very politically popular. And what these have done is transform the way that assistance works so that the conventional kind of disciplined assistance following Bagehot principles no longer exists. Now, there's still some interesting cross-country variation. We look at these 12 countries. I'm conscious that I'm running out of time. It's a pretty good mix of countries from different income per capita standpoint, different kinds of polity scores, different locations. We're going to, as I say, expand it to 60. And what we do is we ask, we try to look at the legislation governing the lender of last resort and try to figure out how much independent lender of last resort power with latitude is being created to do things in these different countries. And those are the sort of variables that we're trying to identify and quantify. And what we find is countries like Australia, the UK, New Zealand, and South Africa have very high scores. That is fairly powerful and independent policy. Japan, Egypt, and Thailand are in the middle. The US, Canada, Kenya, and India, initially at least, have low scores. Saudi Arabia has virtually no lender of last resort authority. By the way, that fits that autocracy story that I was telling you before. What drives these differences, this is my last slide, or second to last slide. So one thing to note is we don't see a lot of change over time within the country, except for one thing, a financial crisis. So when there's a financial crisis, we see some important changes in legislation. By the way, it can go in either direction. What we see is that polity matters, as I've already mentioned. Democracy tends to be associated with more of an independent and powerful lender of last resort. And we also see that deposit insurance and your lender of last resort score are negatively correlated. That is, the old-fashioned lender of last resort countries that give their central bank broad powers also tend to be the ones that are less generous in their safety nets, which is, I think, quite interesting. So there are some other interesting covariates, but I won't go into them. So politics has always governed the powers of the lender of last resort. In its beginning, we saw that with the 5 key conditions that were necessary for the creation of the Bank of England as a lender of last resort. As this evolved, though, different kinds of shocks, Barings, Porfirio Diaz, are using different kinds of mechanisms, securitization, guarantees in the U.S., preferred stock purchases, but they're all following what I would call Bagehot principles, if not Bagehot's rule. And the real change in this is happening in the world since World War II, when we've moved in a different direction toward these blank checks. But we haven't done that universally, and there's still some interesting covariance between the blank check approach and the traditional effective lender of last resort approach, which I think is quite interesting. Thanks for your time.
Thank you, Charlie. Steve, 20 minutes.
So this is a very nice paper. It is a long paper, so, but nevertheless I encourage you to read it. And while they get my slides up, I should have a disclaimer coming up as well that these are not the views of the Federal Reserve Board or any other institution I have been affiliated with at any point in time, I guess. So what does this paper do, which is going to be on my next slide? It tries to answer questions like why do certain countries choose certain land of last resort arrangements. And there's an empirical section which admittedly isn't really there yet, but I think that's going to be in the end the most interesting, I suspect, of this paper if we can get a little bit more of the details of what drives these choices. So here should come the disclaimer. Um, Yeah, the questions. Why do countries choose? What's the role of economic and financial versus political economy factors? And then here, really the political economy is very much emphasized. Although it is a story of a post-World War II political economy, where the land of last resort is, in Charlie's views and his co-authors, a much more of a political choice, with more democratic regimes choosing larger, more extensive land of last resort facilities. Methods, some analytics, I would stress actually you should do more analytics, country review, the cases Charlie mentioned, and then empirics, which is in the works, so to speak. I would give a lot of praise for the paper. It's definitely a worthwhile topic. We have lots of questions. This conference is one of them, but it's not the only one after the GFC. Whether the regimes were right, and we're recalibrating. And actually, in that context, we don't know as much about the land of last resort as we may have thought beforehand. So it's clearly something worthwhile to do. It's very done carefully. Charlie always has a good historical perspective on these things. And it's a start with the economic side. But bring economics and politics together, which is crucial for a topic like that. And it gives us some insight for policy, although I would say there it's still early days as to how we want to take this forward in terms of designing a land of last resort in optimal fashion. So I'm sympathetic to the main story. So I have three sets of comments. And the first one is that this story is not a unique story. It's a story that you can also apply to many other forms of insurance. So it's not only about financial insurance that we see here. I think there's also a lot of more insurance being asked for and provided for in greater democracies at any other level, right? So you talk about health or maybe more generally the size of the government. It tends to increase, and we've seen a big increase after World War II in the more democratic countries. So politics matters in general for insurance. So there's a story there that is more generic here. That risk sharing increase has been related to many other factors. Maybe it's because you're more open, you're more exposed to shocks. More developed countries are more open, so they also tend to be more democratic. So maybe the channel goes through the risk that is increasing, and that's why you see more risk sharing in a general sense in terms of the social safety net, financial safety net. So it may not necessarily be a unique story, but that would mean that actually the channel needs to push a little bit more specific on the channels through which this political story sees itself materializing in the financial sector. Which brings me to the second set of comments. Is okay, why is the land of last resort needed in the first place? Now, of course, we have the budget and other principles, but is it because of an efficient solution, or is it maybe because the median voter was asking for it and desiring for it? That's kind of my question of more insurance in general, and it's just the median voter is asking for it. Or is it really a private interest story, and that is then both inefficient, probably, as well as undesirable. And I think the paper could be a little bit clear on which it pushes. It has elements to all three at the same time, and I think there probably are in the real world all three things happening at the same time. But you would like to see a little bit more of the correlates where you can distinguish between 1, 2, and 3. And I think that really you need to go to the politics in terms of the choices that were being made at a given point in time. And this is almost a question of going away from the level to more the difference in some sense. What happens at a given point in time? Why did certain countries choose certain regimes or change certain regimes at a given point in time? Can we at that point identify political interest to dominate in a certain way according to either one of these three stories? I think then we have the cleanest test possible. Now that's very hard, but you can go back and Charlie has done some, Brandy Crossan has done some. Okay, what were the political economies of Glass-Steagall or whatever with the financial deregulation we had in the US? That was the US a nice clean test you can do. That's probably not realistic in this context always, but nevertheless I would push Charlie from that angle a lot more. That probably also means that I'm gonna ask him a little bit more to tell a little bit more on the externalities as to why land of last resorts, and I'm here using land of last resort as loosely as Charlie used it, in the sense of talk about the safety net more generally. I think many of the political stories for sure are going to go along the same way. But then tell me, nevertheless, a little bit more specific on the externalities that I have in mind. Why do I want to do that? Because they may be changing over time. So let's think about runs on banks. We didn't think they were very important before the crisis. We discovered that they were. Then we also have a lot more fire sales and other forms of externalities, both through the real economy or to asset prices in general. Now, that's a story we analytically we can tell, but there's also an empirical counterpart of it. These things have changed over time since World War II. Now, Charlie, in the discussion we had beforehand, may say, well, also those choices are endogenous to politics. For example, that banks have more mortgages today is a political outcome. Okay, fine. But if everything becomes politics and everything is endogenous, then the paper is going to have a hard time trying to say anything whatsoever. But nevertheless, let's take that S choice as an external, exogenous factor. Then nevertheless, that should tell me something about how I want to organize my safety net given those SS choices. And maybe the cross-country part will help here. Mortgages are not as important in India or in some emerging markets as they are in the US. It's not 70% for sure on the balance sheet. Or take the composition of depositors. Again, we do have changes over time there that should affect the way the LOR operates, and that which should feed into my empirical part in terms of how I want to do it. More generally, the last part is going to be the most difficult thing. The whole system has changed. It's much more market-based. It's hard to coordinate. It's harder to prevent contagion and other kind of issues. But nevertheless, that is the sort of private solutions are going to be much more difficult to expect to operate. But again, you want to take that into account into your empirical part as well, I would expect. The third thing is I would consider always lender of last resort, which is what I said Charlie implicitly does as part of the overall safety net. I find it hard to separate. It clearly was an issue before the crisis that we thought of lender of last resort as not being very useful, but then we discovered afterwards that we had to do both lender of last resort, but we had to do overall banking systems. We had to use all the tools that were available, and I think that is probably always going to be the case. So in that sense, I can't really think of it as a separate one. But I can think of some changes at the margin, some trade-offs between, let's say, lender of last resort and open banking systems when you are in a systemic context that has changed over time. And I want to give you a few slides which are joined with Charlie's co-author. I'm a co-author with Luke on this set of slides. Take the current crisis and compare them to the past crisis. So this actually skips one slide. The past crisis, we had liquidity support that was maybe, this is largely emerging countries plus Japan, the Nordic countries in the 90s when they had their crises. So what did we saw? We saw lender of last resort. By this measure, liquidity support is the only one that I can quickly compare across countries. That was large, 4 or 5% of GDP. This time around, it went up to 15% of GDP for the current set of crises. So the US and Europe and a few other ones as well. So a big shift in support. But that was not the only shift. The old crisis, quote unquote, were in this left-hand quadrant, if you want, up there, where it really was intervening in terms of the asset side, asset management companies, but also bank recapitalization and nationalizations, actually, in many cases. I compare that to the current set of crises. There's some overlap, but there are two missing differences. Asset management companies hardly used this time around, and a lot more guarantees and a lot more the increase in deposit insurance in this set of crisis. Why am I bring up the chart, beside the fact that I happen to have it available easily, is to say things have changed over a lot of times, over a lot of periods, and we want to bring that into an analysis to the extent we can, because I think that may well have been an efficient way of addressing the current crisis. So let's go back to this other charts in terms of liquidity support. In the past, we would give a guarantee, which is typically the height of the crisis at T0 across the liabilities, typically spectrum all the way. And then we would go through due diligence and etc. and do the recapitalization, and this in quarters, like T+6. So quite a while afterwards, we had due diligence, a triage, we had a selection of good banks, bad banks, the ones in between, and we could able to do that. What did we do this time? It went so fast you couldn't even see it. There was hardly any time difference between giving the guarantee and doing the recapitalization. So between October guarantee and TARP, there was hardly any time has passed. Why am I bringing it up? Because I think we have now a different set of circumstances in which the lender of last resort and support in terms of recapitalization have to operate differently because the system has changed. Again, it's one of these things you have to take into account when you look at the changes. They're not only political changes, I think. A lot of them are driven by shifts in the financial system. It's becoming larger, more difficult, and it may well have been the only efficient solution. You couldn't give liquidity support and then wait 6 months or a year before you did the recapitalization. You would have been dead in the current financial system. So on the specific case study, it's great. I liked it a lot. It's very useful. It's obviously going to be hard to generalize, so we all know that with case studies. I would like two things. One, a little bit more context. What are the macro and the fiscal environments? It's hard to compare EMEs that can't issue their own currencies, can't issue much in their own currency. What's the size of the banking central bank relative to the banking system? There's differences. You can bring them out. But crucially, I would like to know more about the political economy. Tell me more explicitly what the politics were at a given point in time. And that's probably where the level versus the change is going to be important. When there was a change, was there actually something of a median voter that was asking for it? Or was it purely a political interest story that drove it? I don't think you're going to do narrow empirical tests, but tell me at least a little bit more along the lines of what other people have done from an empirical point of view. The cross-country analysis, early days, it's a small sample. Great, 60 countries is really going to make this exciting. But even as it is, I think Charlie wants to be a little bit more careful. He talks about scoring. He says the weighting doesn't matter. That's not obvious to me at all that the weighting is not going to matter. He has this big issue on the crisis dummy that changes quite a bit the way the empirics plays out. Now, how to interpret it? It gets dropped in there. I'm sure he's going to refine it. Is it political economy? Is it learning? Is it something else? He has some statements in there that the land of last resort is changing quite a bit over time. I think that depends a little bit on how you look at these two charts. The same data, but it depends how you do a chart, right? If you do them on the right-hand side, the index is 30 and hardly moves. If you base it on the left side, it's 32. And it increases a lot to 35. So it tells me that the level is not necessarily, it's a change really that you're after, and that's really what you want to stress. It's just a little quibble on how you interpret it. And more. Well, you have a statement saying the land of last resort has been increasing over time since the 1990s, especially since the recent global financial crisis. Well, on the right-hand side, it's just the same index plotted that hardly moves. On the left-hand side, I base it at 32, and then it sees a big jump to 35. So I don't know what is the scale? I mean, I don't have a sense of what the scale should be. So maybe it's a very.
I wouldn't emphasize it.
Okay. So on the empirics, I think just a few quibbles. At this point, you want to be careful on your interpretation. You have some things like there. We maybe have deposit insurance and land of last resort are negatively related, so that means more disciplined banking systems need stronger land of last resort. It's sensible if there's substitutes, sure, in the sense of the overall safety net, but it's less obvious from a political economy point of view, right? If from a political economy point of view, the two things would go together always, or at least in terms of your main story. So are you having both? Are you looking at the overall design of the safety net and the components at the same time as you're looking at the level, or you're looking at them separately? And I think you want to think a little bit hard in the empirics of how you're going to do that. So going forward, I have more suggestions for Charlie what to do besides increasing the sample. I would say consider much more explicitly political economy. Go beyond this polity variable. That's a very rough variable about democracy or not. It's not only about democracy, it's about the political orientation. Is it the left or a right regime? Is the economy very unequal? You can have democracies with inequality or without inequality. What's the distribution of wealth and income? Let's really bring in the politics all the way, I would say. And then at the same time, also consider the system in a more broader context. So how large are the depositors in terms of households versus wholesale? What are the other elements of the safety net? And then maybe this changes in the politics. I think that would really get your empirics more solidly grounded in the political economy story that you have in mind. few quibbles on data. I think as is, you could already do a lot to the reader by giving a little bit more of a tables of background data and information that helps support your anecdotes in a more systematic way. It is a long paper, and at times a table can tell a story in a much more easy and clear way. A presentation one, it's besides being long, you have to read this paper in the context with all of the other papers by Charlie, which I typically have done, but not all of them. So, particularly the Calomiris and Harper paper is almost essential to read in conjunction with this paper. So that's something to keep in mind for the audience. You don't want to impose that necessarily on everybody. Yeah. Thank you.
Thank you. Thank you very much. Charlie, you want to make a comment or respond?
Well, the main comment I want to make is thank you. These are great comments. And I knew that when I asked you to come and discuss the paper that I would be glad that I did. But now I realize that I should have just asked you to be a co-author on the paper instead. That would have been much better. But I think I agree with all of your ideas, and we will take them into account. Really good thinking.
All right, we're open for discussion, please.
So it's very nice presentation and a
Your
fascinating. Simon Johnson, as it was in the first session. Fascinating presentation. I hope we can get a copy of the paper. I don't have one, and I don't see anyone else who has one that I can steal. So I hope there are some around that we can get. I think, Charles, once again, you're asking the right question, which is, to what's the difference between Bagehot principles and rules, and to what extent can we try and update those principles and have some sort of reasonable constraint around what a lender of last resort could do, or maybe we're abolishing it altogether. I mean, that's a possibility. I don't think that's where you're ending up, but it's interesting to see the direction. One element I would urge you to consider. I mean, I think also your tagline of cronyism meets populism is harsh, but perhaps not unfair. But just along thinking about that and thinking about ways in which democratic control may have evolved or not evolved since the 19th century or since 1913. Please don't forget that we have a central bank in the United States that is a hybrid of public and private, with the private component remaining from the original 1913 system. Now, I've not heard anyone complain about the Richmond Fed. Let me say that on the record. However, New York Fed does attract some attention in this context, right? Because part of how any kind of lender of last resort was going to operate is somebody's in charge of deciding what's systemic, what's not systemic, who's illiquid, who's got insolvency problems, and the role of the New York Fed has been, I think, controversial at best. Now, Mark said before that we do have an ex post audits to some degree in the United States, and of course that's true. Except if you ask the New York Fed for access to its archives, around these issues, the answer is not after 1960, which sort of fits in with your Bank of England lifeboat point, right? And I think that should be something to consider, Charles, which is, why not have an ex post accountability, a rule? After 5 years we learn something, after 10 years we learn everything about the decision-making process, how you determined who got what sort of support, what was your mechanism for determining anything about based on the available information. That seems to me to be a reasonable update of a Bagehot type principle, but I leave it to you to determine that.
Let me just respond to that, because it's a really good point. So as far as I know, currently, only the Atlanta Fed gives researchers access to all of its relevant minutes. But there is a project underway that I have learned about over the last few weeks to expand that to the other Federal Reserve banks, although it's still, as I understand, under current pending agreements. Maybe Jeff or John or someone else can help us on this. I think it's still going to be a so-called lightly redacted version. But that will be a lot of progress. So I agree with you. I think that it's kind of strange that still, if we want to understand, let's say, Fed policy in the 1930s, we still can't know about it except at the Atlanta Fed.
Let me just add to that, and then I'll pick up. When I was writing the history of the Fed, I followed the practice of having my research assistants go through the board's records, and then I tried to see whether they missed something by going through the New York Fed's records. And I asked for permission to see various parts of the record, like directors' meetings, and Vice President Patricus turned me down, and the president of the bank corrected him and let me have access to anything that I wanted. which was very helpful in learning about the New York Fed. And one of the things I learned about the New York Fed is why at various times there is a real feeling that the New York Fed operates in the interests of its members, especially its large members, instead of in the interest of the general public. I believe there is a legitimate reason for some of those concerns. All right, sorry. Go ahead, Jeff.
Just to comment on Charlie's comment, the 12 presidents of the reserve banks all agreed last year to ask their boards of directors to approve policies, sort of a standard policy across the system of allowing access to the minutes of the boards of directors up until 30 years ago, with a lag of 30 years, lightly redacted. Our policy is going to be for sensitive personal information, like somebody's absent for a health reason. We sort of omit the disease, for example. But this is just a small step that the system can take, and we are pursuing a more systematic process of improving archival access to the Federal Reserve System's materials and improving the preservation, systematically preserving those, which is very spotty. The FOMC records are relatively well preserved, and I think that's a symptom of the political pressure that monetary policies have been under and the movements towards transparency there. But I think on the lending side, you have the records of the discount window areas, the discount windows in each of the reserve banks, and that are obviously sensitive, not to mention sort of supervisory records that could be more systematically preserved and made accessible. So we're working on it. Fed's committed to transparency, but it may take a while. Give us some time.
Well, I think the broad exemption, Jeff, the broad exemption you have for freedom of information because you're not public bodies. That is increasingly hard to defend in this modern political context, in the context of this sort of historical investigation.
Well, it may be decreasingly easy to defend if we meet the spirit of it anyway. Reaction.
Says it meets the spirit. Alan's the only researcher I've heard who's had this kind of access, and I guess Alan is the only researcher I've met who's had this kind of access. And given what he stated about his findings or conclusions, I'd be surprised if they let anyone else in.
Grant, there's more we could do.
I just want to add some further color to this discussion because Eugene White is the one who wrote this paper using the Atlanta Fed discount window correspondence. And what's so interesting about it, we're all aware of, or those of us who've looked at this historically are aware of the fact that the Chicago Fed was and the New York Fed had a conflict about transferring gold. And so that was the point of this paper, was to look at how the Federal Reserve banks, which were sort of like a currency union of their own, had some conflicts about the transference of gold in lending, that is, across the banks. And one of the things that he found that was so interesting was that the Atlanta Fed president had a very, I would say, aggressive, and maybe I would even say I agreed with, perspective on the preservation of the system. The board, which was overseeing this process, that is the Board of Governors, was actually pretty negative about collective action and interbank, meaning Federal Reserve Bank, lending. What the most interesting thing I learned was that after a couple of years passed, the board actually sent the president of the Atlanta Fed an apology and told him that he was right and that they were wrong, which is really interesting. So I recommend that paper to everyone that Eugene's just written, because there was a really interesting discussion and some learning, you might even say, going on about collective action in the Fed that you only will find out about from the Atlanta Fed correspondence, because you can't see the conversation between the Board of Governors and the Atlanta Fed and the other Feds, but you can see the one between the Board of Governors and the Atlanta Fed. It's really interesting.
Further comment? Yes, Doug?
When you get your bigger data sample, it seems like the kind of things you're doing right now are looking whether, say, lender of last resort and bailout sort of go together. It's interesting to think about, related to Jeff's comments before about learning about the regulator, see how it happens in a time series, right? If you do a bailout, what happens afterwards. So you could imagine there's sort of, like right now, there's sort of mean reversion. We do a bailout, so we're going to have a law against bailouts. But you could imagine you do a bailout, you're always going to do a bailout from there on. How does that relate to the political system, given it's not one regulator you're learning about, and how does that relate to the, democracy, that kind of thing? That would be very interesting, because I don't know anything like that anywhere in the literature.
I think we're seeing that working out politically right now.
Yeah, exactly. So I think what's interesting is this is one of the reasons why, let's say, some limitations to the econometric approach here. So if you're looking at the sample that I've looked at, there are pretty much 4 different episodes of significant changes within country in lender of last resort in my sample of 12. They are the United States, which is the 13.3 reaction. Okay, so let's just call that's a decision to rein in the central bank's authority and latitude. Then you look at Canada after this crisis, opposite direction. So there's been an expansion of the Bank of Canada's latitude and powers as a result of the crisis. Let's look at South Africa around the time of the abolition of apartheid. There was no financial crisis, but there was a lot of concern about capital flight. And so when apartheid was being abolished, the central bank got a lot of broad powers to lend to non-financial corporations. Thailand, which is in our sample too, after the 1997 crisis, in 1998, there's a redrafting of the Bank of Thailand's charter to give it much more independence and power than it had before. But also to make the corporate governance much more sort of systematic and effective. So I think what we can say about Doug's point is that there are often important changes in central bank powers that accompany crises. The problem is the crises are very different, and what people learn from the crises is very different. So there isn't going to be a very easy way to systematically describe this, but I haven't given up on it. But I'm just saying, just from the sample I just described to you, there are 4 observations, and they're all about crisis response, but they're all very different.
Yes.
So does your analysis speak? Oh, Anjan Thakur, sorry. Does your analysis speak to this choice that different countries made between you talked about this negative relationship between LOLR and deposit insurance. Was that an active choice as a matter of policy, or was it sort of like what we saw in the US, which is, okay, deposit insurance is for depository institutions. We now find the shadow banking system in trouble. We use sort of ex post LOLR extension. So what extent is that in the data, in the historical data?
So I'm going to now tie together Doug's question, your question, and the point that Stein made about this political economy of these choices. So, and what's driving this negative correlation between the sort of powerful lender of last resort and less deposit insurance. So when we look at it in the data, I would say that the right way to think of it is, if you had a powerful and effective lender of last resort, that's also highly correlated with not having very bad banking crises. And so there's not as much of a sort of opportunity politically or economically for creating this other thing. So think about the countries that are on my list of powerful and with lots of latitude central banks: New Zealand, Australia, the UK, Canada. So these are countries, actually Canada may not have been at the same height now that I think about it, but New Zealand and Australia, definitely. And so these are countries that haven't had banking crises very much. They've been very well regulated. The central bank's broad powers, in the UK too. It's been pretty much, I would say, from 1866 to the last really major problems up until the 2008 crisis. So that's my explanation, that basically these effective powers, and I'm not saying that I don't want to fall afoul of the Lucas critique. I'm not saying that if anyone went out there and created those broad powers, they would necessarily have such a successful outcome. I'm just saying something about the political economy of those countries was able to create fairly good sort of budget principle type systems and also managed to avoid banking crises.
But still, I mean, if you have an indifference curve of deposit insurance and other elements of the safety net, your story is really about that, whether that indifference curve shifts somehow,
Yes.
not indifference curve, it's some curve of a trade-off.
I think so.
But that's not as much how you wrote the paper so far yet. So you really want to say there's a trade-off here, and then we're moving it up and down depending on the politics.
Michael,
So, Charlie, am I to interpret what you said as if we don't have a big crisis, we don't mind giving the lender of last resort a lot of powers and independence? But when we have a crisis and they actually use the powers, then there's a propensity to rein them in? Is that because people think that they're too powerful? Is that the political economy argument?
That is a reasonable statement, but I'm not sure it's true. I mean, I can't claim to really have. I don't know that. I'm still just trying to describe the data carefully, and characterize these policies numerically. That's challenging. Look at their covariates, and I think that we're really at the infancy of this whole discussion. I want to note that this is the first paper I think that's ever been written trying to characterize cross-time and cross-country differences in the power and independence of lenders of last resort, which is itself kind of remarkable if you think about it. So, of course, I don't know the answer to all the interesting questions.
let me add something to that. This is a federal republic. The Constitution gives Congress, under Article 1, Section 8, responsibility for regulating the value of money and the value thereof. Now, we have an agency which has quadrupled the size of its balance sheet without any oversight by Congress. That's not a way to keep a viable political system. And I would say that's got to be somewhere, not explicitly, but in the background of why there is great discretion given to the Federal Reserve, which more than the public likes. That is, they don't make the point that I do, but they're aware of the implications. And that's something which, in my opinion, needs to be corrected. That is, no one in this republic should have that much unlimited authority. That's my view. That's why we're here.
Thanks. I too haven't read the paper. Your papers, especially your long ones, tend to be rich tapestries. So the question I asked may have to do with the thread that's in there, but didn't make it to your presentation. But I'm curious about. So central banks have balance sheets, and the world is a place of myriad financial and monetary instruments and markets in which a central bank can exchange one instrument for another. And we're used to thinking of lender of last resort as separate from something called monetary policy, in which the way we think of it now is we exchange one government liability for a central bank liability that's a monetary asset. So there's this distinction. Marvin Goodfriend has championed this, sort of pushed this idea that that us buying and selling U.S. government, sovereign securities and issuing monetary liabilities is monetary policy, changing the size of our balance sheet. Everything else is credit policy. So from that point of view, if you look at the lender of last resort, there's a lot of things that kind of get swept into the term lender of last resort, and arguably what Bagehot was talking about was really monetary policy by that moniker, because he was lending. It was exchange. I mean, it wasn't a government asset, but he was essentially changing the size of the liability side of the Bank of England's balance sheet to meet the demand for paper notes. And as you know, when the Fed was founded, the problem that everyone talked about was the currency problem, and that was because under the National Bank Act, expanding note issue was very cumbersome, and notes got really scarce in the fall and when there was a crisis. And so it was really to supply notes without the cumbersome collateralization requirement of the National Bank Act that was sort of motivated founding the Fed. And then there's this question, what assets? Government security seemed right out, since that was the problem with the old system. And
That was banned. They were not allowed.
That's right, we weren't allowed
to
until
buy any government security
until World War I.
or even to make short-term loans to the Treasury.
For a short time.
Well, until the 20s.
Right. And you know, at the founding, the founders, I think you're right. You talked about central banks before World War II being willing to watch individual institutions fail, and I think that's the attitude the founders would have taken too. They opposed adding deposit insurance to the bill, as you know. So over time, it's sort of morphed and morphed. So now, the striking thing about 1970, that date you guys identify, is that that's the beginning of fiat money, and at the time. That opens up central banks to a tremendous amount of pressure that they were capable. Alan's probably more of an expert on this you are than I am, but I would suspect they were much more capable of resisting prior to that under Bretton Woods and under the gold standard. So now they're opened up to a tremendous assault on a variety of fronts, including using their balance sheet for all sorts of stuff. So in 1970, William Proxmire is harassing the Fed because in 67 they gave us the ability to buy agency-backed securities, Fannie Mae and Freddie Mac debt, and they're saying, why haven't you bought any yet? And a year later, Burns caves and we start buying agency debt. We ended up owning the debt of the Washington Metro. In case any of you have come here, it's courtesy of the Federal Reserve. And our credit allocation. So I'm wondering if there's something to be explored there in terms of kind of the explanation for the evolution of lenders' last resort from dealing with systemic crises, like there's not enough paper notes in the system, to selective rescues of politically favored institutions, creditors.
The Fed was founded. Oh, I'll let Charlie answer. Go ahead.
Well, I actually do want to give a response to this because it's a very rich point, and I have 3 different things I want to say about it, but we could then go back and forth over lunch quite a bit. So the first thing I want to note is that the end of Bretton Woods can also be understood as a political outcome. And in fact, Barry Eichengreen's discussion of the financial globalization trends and democracy trends and the movement from fixed exchange rates to flexible exchange rates thinks of this as a political explanation. So his work argues that basically democracy, and especially, I'm going to put words in his mouth, democracies that have lots of labor unions become myopic. So socialist and labor union influences in democracy and the spread of suffrage make democracies more myopic and basically less able to maintain fixed exchange rates from a macroeconomic trade-off standpoint. And that is the political economy Barry talks about as explaining why by the 70s, those same shifts that I'm talking about on the banking side in deposit insurance are showing up on the monetary policy side too. Now let me make another connection there, thinking about Canada. So Canada is the hero of my book with Steve Haber. They have had extremely good banking system regulation and outcomes. And we argue that that has to do with the Canadian Constitution, which itself has an interesting history. That it's basically a classical liberal document, meaning fairly resistant to populist pressures. What's interesting is if you go back and look at the 1960s and the 1970s, when the US inflation rates are going up, and if you look at Canada, you'll see that inflation rates did go up, but by much less. So if you compared, let's say, the UK, Canada, and the US, and just said, which central bank was able to resist inflation the best of the 3? It was Canada. So I think there is this connection Eichengreen's talked about that also we can talk about in terms of the politicization of monetary policy in the US, which I think, as Alan has written about at length, has been a serial problem throughout the Fed's history. Now, the last thing I want to say, though, is that as much as I agree that we want to try to keep monetary policy in Marvin's definition of it that you cite, we want to try to keep it somehow not fiscal. There's a problem there. So let's take the Barings crisis. The Barings crisis was, the intervention the Bank of England did was not about affecting the aggregate amount of credit or the aggregate amount of money. It was about resolving making a confusion irrelevant. They made the confusion about what the potential effect of Barings would be on each of the individual clearing banks irrelevant by structuring a mechanism that meant that confusion about the risk wouldn't affect the systemic outcome of the system. That required them to actually do something that I would describe as a fiscal intervention. And I also want to point out, this wasn't just by government, even by central banks. The equivalent thing was done by the Canadian banks on a voluntary basis before a central bank was created in Canada. So the Bank of Canada was created in 1935. But twice in the first decade of the 20th century, the Canadian banks decided to pool their resources to bail out, that is to acquire and to share the costs on a prorated basis, a failing bank. They didn't do it otherwise. They often let banks fail, but if they believed that the consequence of the bank's failure was systemic, they actually privately and voluntarily acquired the bank. Why? Because it made it clear that whatever daisy chain concerns the market might have were now irrelevant because they were being borne on a pro rata shared cost basis. It was a way to basically, so a lot of what central banking guarantees are about is taking uncertainty about the incidence of shocks and making it irrelevant through collective action. Making an ex ante uncertainty, ex post of the action irrelevant. So I don't agree with, it's very hard for me to say this on tape that I don't agree with something Anna Schwartz said and something that Marvin said, but I don't agree with the view that they had written about in the 80s and the 90s that suggested that all lender of last resort interventions could be achieved through open market operations, which is part of the question that you talked about.
When the Federal Reserve started, there were two rules. The people who wrote the Federal Reserve Act practically never discussed what we now consider to be the role of monetary policy. They took it as given that they were going to be on the gold standard. So the idea of doing things about unemployment and all that just did not enter into the discussion. The whole discussion is about lending in crises and protecting various special groups. So they wrote two rules to protect the central bank. One was the gold standard, gone. The other was the rule that said you cannot lend to the Treasury at all, even if the Treasury is short of cash. They relaxed that later. But the big relaxation came when they discovered that they could use open market operations to change interest rates. Because since they weren't allowed to buy Treasury debt to finance the Treasury, they had circumvented it because they could buy it the next minute in the market. That was the end, it took a while, was the end of a real restriction on the central bank. Now, later, Martin tried to reinstitute some of that by bills only, and that gave rise to tremendous political pressures on the Fed, which he finally gave up after the election of the Kennedy administration and in a deal that he made with the White House, with Heller and Tobin, to buy longer-term government bonds. But he didn't like to do it. And one last story, Jim Tobin, who was a member of the Council of Economic Advisors, used to keep a record of how many long-term bonds the Fed would buy under the idea promoted by the Council. And when the number didn't satisfy him, he would try to get the president to call a meeting to pressure the Fed to do it. But Martin was not a man who was easily pressured, so he didn't buy very many government bonds. That's a far cry from where we are today. Further question? Yes, Jeff?
This exchange with Charlie. What I think Marvin Goodfriend and Anna Schwartz were claiming is that lender of last resort, as Bagehot conceived it, was about note supply, and that open market operations in the modern era, with a rich and liquid government securities market, sort of unlike I think the 19th century, would suffice. I think your account is consistent with the notion that the term lender of last resort at many different times envelops a range of different interventions. Right. Now, you talked about Barings. I think it's obviously I think it's obviously credit allocation in Marvin and Anna's terms. Yeah. But Bagehot, but do you consider that sort of consistent with what Bagehot would have recommended as what sort of the narrower
Yes.
version of lender of last resort?
I mean, quick answer is yes, because again, Badgett understood that I think he understood it, that the intervention that he was talking about had to do with um, resolving a market problem about uncertainty, not just by creating a sort of supply of liquidity, like helicopter drops. If it were just about liquidity, would a helicopter drop have solved the problem? No, because it was about banks' exposures. And I think that was essential in Badgett's thinking too. So I just don't agree that that was the sort of what this was all about. It wasn't just about the supply of money or even the supply of lending in some aggregate sense. It was about the exposures of financial institutions all along.
Further comment? Let me say, I agree with Charlie that Badgett was a market man as well as an economist, but he was a very good economist. He understood first the reason for a penalty rate, but most important of all, he didn't criticize the Bank of England for doing the wrong thing. He criticized the Bank of England over and over again for not announcing in advance what they were going to do. That is, he wanted a rule. He wanted a rule, and he was in his early days, that is, he was an early proponent of what we would now call rational expectations. He said, if you announce the rule, you bring stability. If you wait until the last minute, you'll never bring stability. That was the purpose of the rule. And Badgett understood that way before we did. That was further comment. All right.
Can I say one thing? Just because Simon asked the question about the availability of the papers. The papers are going to be, some of them hard copies are probably lying around somewhere. But in addition to that, the papers are going to be up on the website. This, I should have said earlier, all of our deliberations here will be up on the Hoover website, and there'll be links to the papers as well. I guess it'll be up to the discussants whether they want to put their slides too, but I hope they will.
I want to start by thinking about the contrast between banking industry and the derivatives industry in the United States. In the 19th century, regulatorily, both would have looked the same, both largely self-regulating, both largely self-reliant in the cases of emergencies. In most of the 20th century, in contrast, they've had different regimes to work within. Banks have had a lender of last resort regime, whereas futures markets basically had to manage on their own. But this distinction is now beginning to come to an end. The Dodd-Frank Act in itself does a lot of makes a lot of important changes, but one of them, the one that we are interested in the most, is the effects of it on the derivatives industry in particular. In Dodd-Frank, there are new statutory constraints, constraints on individual lending, which are heavily constrained now, only in unusual and exigent circumstances, and only through borrowing with broad-based eligibility. On the other hand, there is a new statutory extension there. That extension explicitly authorizes emergency credit for certain financial market utilities, and that includes central counterparties, again, under limitations. Well, the role of a central bank as a lender of last resort is a question which is an old and vexing one. Finding the correct, credible limits for the behaviors of what a central bank should or should not do. It's a dilemma historically, a dilemma discussed by Goodhart in his 1988 paper, of course, also discussed in the paper that we just heard about from Charlie. It's a puzzle in other contexts as well, where the question of what's the right constrained discretion arises whenever similar kinds of protection arrangements arise. The problem, the basis of the dilemma is this fundamental conflict between the ex post externality from the failure of an infrastructure, and that's going to require liquidity support for continuous operation. On the other hand, that liquidity support raises ex ante moral hazard problems. So, what's in this paper? In this paper we've got, we've got an extra slide. Ah, thank you. Thank you. Wonderful. of this paper is a simple theory of rules as constraints to a lender of last resort function. Tightening or loosening the lender of last resort rules tightens or loosens the central bank's discretion. That's a subtle issue because ex post in this world, everybody is going to want workarounds for the rules that have been put in place in the first place. That is, more specifically, in the spirit of this conference, in fact, what we're talking about is a situation in which codifying conditions for central bank lending provides counterweights to the moral hazard from the private sector anticipating the support. But imposing infinite costs on a liquidity provider for a bailout is neither credible nor would it be desirable. There's a lot that's not in this paper. We're going to be ignoring the problem of the agency problem that arises between lawmakers and regulators. It often describes the problem of shirking or a problem of regulatory capture. In the world that we're going to be looking at, there's just the time consistency problem. That is to say, the central bank is out there trying to make short-term repairs. The legislation is put in place to provide for long-term commitment. And we're going to use our model to distill some rules of thumb for balancing the ex-ante cost of the moral hazard and the ex-post external cost of a failure to provide a bailout. And we're going to examine some liquidity crises or crises in general at central counterparties in order to relate those rules of thumb back to the Dodd-Frank constraints. So, the plan of the talk and the plan of the paper is to do the following four things. I'm going to start by describing that recent regulation. And I'm going to then compare what's going on in Dodd-Frank with what's going on in the central counterparty's traditional safeguards. I'll present you the model very briefly and show you how the rules of thumb come out of it. Those rules of thumb relate to the questions of extent of the externality, costs of adjusting CCP's levels of protection, likelihood and extent of failures, and consequences of failures. And then at the end, I'm going to talk about examples of failures. Well, I'll talk about 1.5 examples of failures to see what the links are between what we're proposing and what's there. So let me start by describing the recent legislation. And this is the point where, in particular, I regret not having Robert here because we're, as the two non-lawyers on this in this triumvirate, we're particularly at a disadvantage in describing it, but I'll do my best anyway. So Dodd-Frank's revisions to the Federal Reserve Act provide in a general non-bank lending program that the Fed has certain procedural safeguards it must go through. It's got to consult with the Secretary of Treasury. It's got to do actions that has specific substantive things that must be satisfied for it to be able to make a non-bank lending program. That is to say, it shouldn't be aiding a failing financial company. Security must be good. Termination must be timely and orderly, and the programs in general must treat borrowers and banks, banks must treat borrowers equally. This broad-based eligibility is required. Time out. We're going to talk about central counterparties, so I better tell you at least, for those of you who don't know, which I'm sure is one or two in this room, what a central counterparty is. Central counterparty is an institution that engages in counterparty substitution through novation. That is, in an organized derivatives market, it becomes the buyer to every seller and the seller to every buyer. What it does is it stands there between clearing members. Clearing members submit trades for clearing through the central counterparty, and in doing so, the central counterparty provides centralized risk management foundation and efficient data processing. And the central counterparties have been regarded by many as an important part of the solution to the problems that arose in the recent financial crisis. Now, a financial market utility, according to Dodd-Frank, is any multilateral system for transferring, clearing, or settling payments, securities, or other financial transactions with a financial institution. In other words, it includes lots of things, but one of the things that's in the list are central counterparties. And according to Dodd-Frank, the Fed is now authorized to provide account services, and potentially to provide credit to systematically important financial market utilities, and that includes central counterparties. In particular, unlike the rest of the legislation, this allows for lending to individual borrowers. Individual central counterparties can be given loans under certain safeguards, unusual exigent circumstances when you can't get the credit from outside, and under procedural rules about getting a majority approval from the Board of Governors and a consultation with the Secretary of the Treasury. All right, that's interesting. How do you become a designated important central counterparty? That's a decision that's made by FSOC, and it so far has designated 5 central counterparties as systemically important and therefore potentially eligible for all of this stuff. The ones that are of interest for us in this discussion right now are the MERC, the Chicago Mercantile Exchange, and the Option Clearing Corporation, but there are 3 others on that list as well. Okay, so that's what's in the new legislation. Let me compare what's going on there with the traditional protections that were available for central counterparties, with traditional protections that were available, for example, for the Mercantile Exchange. These protections vary slightly from one to the other, but it's close enough that I'm going to treat them all as the same in this process. The main protections came in 3 different categories. First of all, central counterparties protected themselves by their membership standards. Traditionally, they were clubs, and they set up requirements as to how good you had to be a member of the club. In addition, they protected themselves through margin, that is, collateral policies. If you're going to make trades on this that were going to be cleared through the central counterparties, those trades had to be protected through margin requirements. And finally, the central counterparties also had available to them a variety of additional resources, default funds and CCP capital that could be used in the case of emergencies as well. Let me give you an example of how that worked. Let me give you that example by thinking about what would have happened if you have a defaulting clearing member owing margin in a trade that's gone south and now is refusing or unable to pay up. What happens in those circumstances? What happens to make the central counterparty good? Well, that's usually described in terms of the jargon for it as a waterfall. And so here are the various steps that go into that waterfall. The first level of protection for against a defaulting clearing member is the defaulting clearing member's own margin and net positions. In other words, the defaulting clearing member's house positions are liquidated. The gains from that liquidation are not paid out, and any losses that are going to be sustained are going to be protected, at least at the first instance, by the defaulting clearing member's own initial margins. Meanwhile, the defaulting clearing member's customers' positions and margin accounts are all transferred to another clearing member so that they are kept whole. But that's only the first step in the waterfall. After we have a problem, if we have a problem with a defaulting clearing member, where the problem can't be handled by only the funds of that member, then the next step is the clearing member's contribution to a default guarantee fund. That contribution was made ahead of time and is there available for just this kind of a problem. If that's not enough, then the next step is going to the central counterparty's own capital. Central counterparties originally were clubs, but now they tend to be limited liability corporations, and they are required to have their own skin in the game, and that is available. The capital that they have is available also to provide protection in the case of crises like this. After we've run through the central counterparty's own capital, there's still other levels of protection that are available. Those include, in particular, other clearing members' default funds. Those contributions are mandatory and pre-funded as well, and if situations get really bad, those are also available as protection against the failure of this initial counterparty. If we run through all of those as well, then in principle there's another place you can go, which is to mandatory assessments from all the members. The rules for typical central counterparties say that anybody who is a member of this particular exchange's CCP can be assessed to bring in additional funds if they're needed in a crisis to make up for the shortfalls. That probably doesn't have much bearing because if we've gotten that far, everybody's probably in trouble. So it probably doesn't help a lot to say you've got these mandatory requirements out there. But interestingly enough, the next step down the line, elective assessments have historically turned out to be useful as well. When there is a general crisis, it's turned out that there are sometimes cases that some member or another is actually doing well and is finding it sufficiently valuable to keep the exchange itself going that they are willing to put up, under the right circumstances, funding to help out in the emergency. After all that, the new step now is for the Fed to be in there. Of course, that leaves an interesting question. Putting the Fed in at the bottom of this list means that you now have to start worrying about whether that's going to knock out the willingness of individuals to be participating at earlier stages along the way. In the paper, we give examples of the operation of this kind of system of protections. One successful example, one unsuccessful example, and one example that's sort of in the middle. Let me tell you about the successful example to start with. The successful example is the case of, that we have in the paper, is the case of Refco in October of 2005. At that time, Refco was the 6th largest clearing firm, and it suffered a bankruptcy. Basically, the bankruptcy was unrelated to what was going on in the clearinghouse itself. It was related to some bookkeeping fraud in another portion of the business. And at the first wind of that particular problem, the CME clearinghouse quickly jumps in, sends auditors in to be able to take over. They know the business already. They coordinate, importantly, with other clearinghouses with agreements not to put any additional margins on their trades in other clearinghouses. And they sell off the positions quickly, and they use the margin to cover the crisis. The funds for the customers have been set off separately, properly, and so customers' accounts are transferred quickly. Customers don't, in fact, notice much problem at all from this. So, in fact, the accounts of Refco end up being taken over by Man Financial. Man Financial eventually becomes MF Global, but that's a story for another day. A large firm going under, having virtually no effect on the operations of the mercantile exchange. A successful example of a protection where customers of the exchange basically never notice the difference. We need to contrast that smooth operation with situations where the operations have been less smooth. And so a useful contrast would be to consider the second failure of Barings, which is the failure of Barings in 1995, where rogue trader Nick Gleason was supposed to be arbitraging trades between Cymex and Japan, and instead of arbitraging, put on what people in the business call a Texas hedge, doubling up. Turned out that the crucial distinction here was that international differences in the way margin accounts got treated meant that customers' accounts were not transferred quickly. It took 4 days to get the customers' accounts transferred from Barings books to books of other traders. 4 days may not sound like a lot, but in derivatives time, 4 days is infinity. And so the disruptions that came out of this were widespread, serious, and seriously damaging to that market. I painted a rosy picture describing these things. That rosy picture is a little unfair in some respects because, in fact, the protections that are afforded in the rules of the clearinghouse really are protections designed to protect the market and the clearinghouse itself from the default of these members. They are not focused on the customers in particular. CCP's guarantees of performance only extends to the clearing members, not to third parties. There are other limitations as well. Regulation of market segregation is necessary to make it work smoothly, and the bankruptcy code has some problems in it in terms of from the point of view of customers, because although they can be protected from the clearing members, they're not necessarily protected from other customers of the same company. There can be a pro rata distribution of losses among them. Nonetheless, that system seems to work pretty successful. And at the time, pre-Dodd-Frank, The role of the government in this seems to have been minimal. There were several important pieces to that role. In particular, the government's rules about bankruptcy and automatic stays and the way they favored or did not favor various individuals mattered a lot for the workings of this arrangement. And it's not quite true to say the governments did not have a role at all. If we look at the 1987 crisis, financial crisis, we see an interesting and important role for the government there. In 1987, in October, there was a financial crisis. That crisis put pressure on throughout the financial system, but in particular, it put pressure on the market for options. On October 20th of that month, of that year, the Options Clearing Corporation, which was the central clearing, the central counterparty for the options market, had already faced one failure of a member and was about to face another failure. This time the failure was by a company called First Options. First Options was an important trading company, but most interestingly, it was also a subsidiary of Continental Illinois, and it was in trouble. And the Fed was going to be providing liquidity to the financial system overall, but the question was whether that liquidity was going to be able to flow through to First Options. Here's what the problem was. At the time, there are two OCCs in this story. It's important to keep them straight. There's the Options Clearing Corporation, and on the other hand, there's the Office of the Comptroller of the Currency, which was the regulator for Continental Illinois. And the regulator was had been worried about contagion, had been worried about Continental Illinois owning an options company, and therefore getting into trouble where contagion from the futures market could affect the stability of the banking system. And so for that reason, they had limited the amount of lending that First Options could get from Continental Illinois. But in this crisis, OCC reversed itself on this, allowed additional lending to come through, and in that way allowed for liquidity to flow from the banking system to the derivative systems, despite the fact that they were in fact going against their own rules in the process of doing that, or their own rules as initially set. Okay, that's been a description of how CCPs have worked traditionally. What I want to do next is describe briefly for you the model that we're using for this and the rules of thumb that come out of it. In our model, we think of a clearinghouse as a club of clearing members. It provides some value to a group, and that value has a distribution, it's random, and there are actions that the clearinghouse management can take to make its own system safer or less safe. In addition, it's providing a social value, the clearinghouse is, and that social value is increasing in the values that it provides to its members as well. Lender of last resort in this world has a technique called rescue to bring the value of the clearinghouse from negative to zero. So it would be desirable to do that whenever the clearinghouse is in a negative position, to bring things back up, to bring social values back up. But the club that is the clearinghouse is subject to moral hazard in the choice of its actions. Increasing these actions increases the cost of the clearinghouse, but it improves the distribution of social benefits. In this world, in the absence of any moral hazard problem, you'd want the rescues to happen all the time. The legislature is going to put legal restrictions on the actions of this lender of last resort by imposing a political cost. That's the way we think of it. And so the lender of last resort is only going to rescue when the benefits from that rescue exceed the political costs that the lender of last resort faces. In effect, the legislature chooses a cutoff level for rescue. Rescues will happen when things get bad enough, but rescues won't happen when things are not so bad. And the level of badness is in fact determined by the stringency of the legislation. Understanding this, the club decides on what kind of actions and what kind of care to take. And so it's the job of the legislature to choose cutoff levels to maximize social welfare. That is to say, taking into account the responses that the club is going to make, the degree of care it's going to take as a function of the ease with which it can be rescued. From the simple model, under certain circumstances, which are simple but at least reasonable, we think, we get a bunch of rules of thumb. Let me just go ahead and summarize them for you. The rules of thumb come out to say things like this. If the expected cost of that unresolved crisis is small, you're going to tighten the restrictions. If the externalities that come out of these things are great, you're going to tighten the restrictions to keep them from arising, but you only count externalities that are not going to be remedied by the intervention themselves. If the externality is remedied, then it's not going to count as something that you want to make things tighter for. If the restrictions don't significantly affect the behavior on the margin, you want to relax those restrictions. The whole point of these restrictions on the legislation is to keep the moral hazard at bay, but if moral hazard can't be kept at bay by these things, then it's silly to go out and put those tightenings in place in the first place. In the paper, we talk briefly about why this is relevant for clearinghouses. It's a general model that could describe any legislation, principal agent problem, but we give some arguments as to why we think that it actually catches quite nicely what's going on in the case of clearinghouses as well. The final thing that we do in the paper is to talk about some examples of failures. Let me talk briefly through one of those. That's the Hong Kong Futures Guarantee Corporation. So, in Hong Kong during the financial crisis, there was also a failure of the futures market. The source of that failure was the same source. It was the international failure. It was a failure of the, basically it goes back to the United States. But in Hong Kong, there were a variety of weaknesses in the market structure and governance. And so, including in that was an inadequacy in the guarantee fund and a bunch of political games that were being played as well. Now, that market was important for Hong Kong. It was regarded as an important part of what made Hong Kong a financial center. And so it would be believed quite readily that the government would be interested in bailing them out. Not surprising there. What was interesting was that the bailout form pretty much corresponds to the form that Charlie described in the earlier case. That is, the bailout was a combination of government and private bailout. Lots of international corporations, lots of international financial groups trading in Hong Kong were also interested in having that bailout happen. And so the government put together an arrangement where the government had the superior tranche and the financial institutions had the inferior tranche in the world. And as part of the arrangement, the international groups insisted on an improvement of the governance, in fact, fairly significant improvements of the governance. So quid pro quo of them joining was for a change in the structure or the arrangements of this party. So the question is, in that world, would a formal arrangement for a lender of last resort have made any difference? There was no such thing at the time. It's hard to see how it would have made any difference for incentives. The incentives were the arrangements that had been put in place already were pretty bad, and therefore putting in some protections wouldn't have made them any worse. It was expected that there was a guarantee. It was expected probably that the governments would do something. But the interesting question is, if the guarantees had been in place ahead of time, would the private investors have come in and made their own contribution? And if they hadn't made their own contribution, would there have been any cleanup in the process? So, let me summarize. Dodd-Frank explicitly authorizes the Federal Reserve to act as lender of last resort to systemically important CCPs. These CCPs have traditionally had their own protection arrangements in place. And what we've done is modeled a situation in which a lender tries to find or the legislature behind the lender tries to find the optimal level of rescue for these kinds of corporations. And in the paper, we've begun to apply these qualitative results to thinking about examples of CCP failures. And the conclusions that come out are the following. First of all, a restriction of power of lender of last resort in normal times so as not to dilute CCP membership margin standards. That seems to be pretty clear. And it seems to be pretty much consonant with Dodd-Frank as well. It's unlikely that there's going to be any temptation for regulators to take this as a temptation to do rescues in the case of individual failures. And so it's unlikely that it's going to do too much in the way of diluting membership or margin standards, typically for CCPs. On the other hand, CCPs are not equipped, not intended to be equipped, to deal with systemic crisis. And in those cases, there's probably not much difference from Dodd-Frank either, because in fact, by now, lender of last resort assistance is probably already anticipated in those cases. Since 1987, it's now become so important, these have become so important, so central to the financial system, that it's probably not credible to say that in cases of real systemic crisis, protection wouldn't be afforded in derivatives markets as well as in the banking system. The problematic cases are the cases that where the crises are large enough to create spillovers into other parts of the financial system, but might not be regarded as systemic. And in these cases, Dodd-Frank probably is going to make some difference, and therefore default funds become increasingly critical points for regulatory scrutiny. Those ends of the waterfall right before the Fed is supposed to step in are probably going to be the weak points in the story and the ones where additional attention is going to need to be paid. Thanks very much.
And thanks very much, Charlie. And now we'll hear from the discussant, Mark Carey. Echo the thanks of others for being invited to speak at this interesting conference. I have two non-standard disclaimers. Non-standard disclaimer number one is that I'm staff at the Federal Reserve Board. Staff don't speak for the system, so nothing I say is newsworthy. My second disclaimer is, as of 3 days ago, I knew approximately nothing about central counterparties, but I went and sat for 90 minutes with one of the true experts, and so now I know a little bit. The result of my education is that, my big comment on the paper is that the words that are used are not congruent with the sort of reality either of the legislation or of how things would work in central counterparty land. So what I would suggest you do in sort of revising the paper is, instead of saying it's about lender of last resort, which to a Federal Reserve person means roughly discount window lending or special facilities, use capital injections. Second, it's not clear in the paper that you're interested only in derivative central counterparties. There's another kind as well, which I'll talk about in a minute. Third, the restrictions that the model suggests are the way to get a trade-off optimized between moral hazard and protection of social value should be called ex ante prudential supervision and regulation of things like the margining and the default and guarantee funds. So let me sort of go into the details. Let me see if I can make this work. Nope. Sorry. Oh, the right side, not the big one. Yep, there we go. Okay. So, the model makes a useful point, which is we want to arrange the world in a way that avoids really bad outcomes for society in the event of a problem at one of the counterparties of the central counterparty. And we'd also like to limit moral hazard on the part of the central counterparty and its controllers in terms of not properly ensuring up to some point in the distribution of bad outcomes. One more, sort of overall comment on the paper. To a non-attorney, the discussion of the sort of law and rule of law, so forth and so on, is a little bit confusing. And the thing that's missing is that Dodd-Frank actually didn't fix this problem, which I'll make clear in a minute. Dodd-Frank gave the Federal Reserve power to make discount window loans to central counterparties, but as I'll argue in a minute, that power is useless in the situation that we're concerned about. And Dodd-Frank did not make provision for a resolution authority with a call on central government resources in order to essentially keep a central counterparty afloat that's in distress. So we've got a kind of incomplete protective setup, and you'd be doing a service if you made that clearer, because people could easily think at the moment that the Fed can like fix the problem because it's got this lender of last resort authority, but it really can't. Okay. Uh-oh. Sorry. Okay. So I want to give a tutorial about central counterparties. And this is on US. This is a tutorial on central counterparties in the United States. And it's complementary to what Charlie said. Everything that Charlie said is accurate, but there's some additional background that I think is useful in thinking about the problem. First of all, there's two types of central counterparties. One settles securities trades. It is a trade clearing organization. I buy, $100,000 of Dow Chemical shares. At T+3, I have to deliver cash, and somebody has to deliver the shares to me. And what the trade clearing CCPs do is stand between me and the ultimate seller and ensure that the seller gets their money if I default, and ensure that I get my shares if the seller defaults, with the caveat that the CCPs don't care about me, Mark Carey. They're only guaranteeing the performance of the clearing members. So my broker would be Fidelity Investments. Okay, so they would guarantee that Fidelity would do what it's supposed to do. Nobody's protecting Mark Carey. I'll be a claimant on the estate of Fidelity Investments for my money if I don't get my shares because Fidelity's broker has failed. Second, there are derivative central counterparties. Let me emphasize in the securities settlement case, the time span over which protection needs to be provided is very short. We're talking about a failure that occurs between T and T+3. Okay, and by the time T+3 is over with, as long as everything has cleared, the game is over. And we're not worried about long-term contracts or transferring positions or anything like that. It's different with derivative central counterparties. They are there standing between the buyer and the seller of a derivatives contract until the contract is done, for the entire life of the contract. Okay, and so one could think that the central counterparty has got this enormous portfolio of derivative positions. That's not exactly right. In ordinary circumstances, the central counterparty is just facilitating the transfer of margin from one party to another. It's only if one of the clearing members fails that they have a portfolio dumped on them, but they do have a portfolio, and they're going to have to manage all the risk associated with that portfolio. Because the structure of these two is very different, the issues that arise and the nature of the assistance that is required in the event of a failure of one or more clearing members is going to be very different. Let me note in passing that the Fed is not the primary regulator of either type of these central counterparties. It's the CFTC and the SEC. Okay, the Fed is a secondary regulator, and it has this power to make discount window loans, which I'll argue in a minute is useless. Okay, I'm afraid to press it again. Let's see what happens. Okay, so the trade clearing central counterparties are all members of the depository trust and clearing corporation family of firms. Although they are joint stock companies, they're really utilities. There are no equity holders in the traditional sense. If you're going to be a clearing member, you're going to have to make an equity contribution, and you're going to get a seat on the board of the entity with the amount of voting rights that you have, depending on the amount of activity you do at the entity. Okay, but it's not like you're going to get net profits at the end of the day. The central counterparties charge fees for clearing every transaction. They take their costs out of the fees. Whatever's left over at the end of the year is rebated to the members. Okay. That's sort of important for moral hazard purposes, right? Because the members might want to economize on the portion of the fees and on certainly the margining requirements and the capital contributions that provide the protections against failure. But as I'll argue in a minute, it's not obvious that that's the case. In the paper, it's just sort of presumed that the central counterparty is going to try and take advantage by not protecting itself very much, but there really isn't a residual claimant in a sort of single shareholder, equity holder sense. It's all of the members who are residual claimants on the savings, okay, and the members don't trust each other. I think that's an important thing that one would want to model. Okay. In other words, governance should be modeled. Come on, puppy. Okay, so exactly what happens if one of the clearing members defaults? Well, the central counterparty has got to deliver securities to anybody who is owed securities, and it's got to, meaning clearing members who are owed securities, and it's got to deliver cash to anybody who is owed cash. Okay, now the cash is going to be the problem in a rescue sense. Okay, because we're talking about sort of all of the buys during the last 3 days, if we're talking about the equity clearing corporation, that this clearing member has done are going to have to be paid for. So it's not like the net trade amount, right? It's, you know, the central counterparty is going to have to pay for the gross amount. So in principle, you would think that this is a perfect example of an opportunity for Fed discount window lending to help, because here's the central counterparty. It needs an enormous amount of cash, but it's got an enormous amount of collateral. And lender of last resort lending is always, always collateralized. However, there's a problem. The problem is that the central counterparty has got some cash reserves, but it has a huge line of credit. Where it plans to get the cash is by drawing down on its huge line of credit. And that line of credit is a secured line of credit. So there's no collateral available for the Fed to take in return for its discount window loan. There is no way for the Fed to use its ordinary lending authority as it is organized to help this failing central counterparty. And by the way, the central counterparty is only going to fail if it exhausts its resources. Okay, so, you know, what you need here is somebody who is not the lender of last resort as it's organized in the United States, but some other entity with enough capital that it can go somewhere, I don't know where, and get a large amount of cash, but only for 3 days, right? Because the stuff that the clearing member who has failed has sold, cash is going to come in for that over the 3 days, and the portfolio is going to be pretty self-liquidating. Okay. Okay, you know, Charlie went through the sort of waterfall. First, it's the margin of the failing, you know, a clearing member. Then actually, I'm not sure where in the waterfall this happens, but it's every clearing member's margin is exposed to making sure that everything is settled properly. It's the default funds, it's the assessments. There's a whole setup that is designed to anticipate the failure of at least one and sometimes two major clearing members under market price move scenarios that are worse than have ever been seen in history. Okay, so the situation in which the CCP cannot handle this problem itself is a situation in which the world is on fire in a way that we have never seen. Because remember, it's all happening between T and T plus 3. So you have to have clearing members fail, multiple clearing members, 3 or more clearing members all fail within a 3-day period. Right? I mean, this is, and they've got to be big because they've provisioned for failure of a big clearing member. Okay, so it does seem to me like a situation of extreme systemic risk and one in which it is in society's interest to make sure that the problem does not spiral even further out of control. However, the Fed can't help. There is no entity that is a resolution entity in the government which has powers to intervene and inject resources. And remembering that all has to happen between T and T plus 3, I don't think there's time for the legislature to, you know, have a debate and pass a law and get it signed by the president. So the hole in the system is that the government doesn't have a prearranged resolution authority like the banks have in the form of the FDIC. We are depending on the central counterparty's own provision of default funds, margining, and so forth. That is supervised by the primary and the secondary regulators, but they are making a more or less explicit decision about how big of a problem are they prepared to handle, and beyond that, the system does not have protection. Okay. Okay. Yeah. Okay, so, bottom line, really, to me, the bottom line of the paper is, we've already got a situation in which the regulators are, in effect, specifying a point beyond which rescue will occur. And they're specifying that by forcing the central counterparty to have adequate margining policies, adequate default funds, adequate assessment capabilities, and in the case of the derivatives counterparties, as I'll say in a minute, adequate capital or skin in the game for a failure on the part of the clearing members of a given size. Beyond that, they're just not thinking about it, right? They're assuming that somehow someone will come forward with the funds. But for these counterparties, it's got to be between T and T plus 3. Okay, so Dodd-Frank is incomplete. The Fed can't do it. Derivatives counterparties, a crucial difference in my mind is that these are for-profit joint stock companies. Okay, and the only thing that makes it helpful is that, again, what the clearing members fear is that one of the other guys will fail, and the margin that they have put up and the default funds that they have put up will be used to resolve that failure, and to them that's a total loss. Okay? So they don't trust each other, and they're worried about the wealth that they have put in, and they can see all of the risk management arrangements. So although the joint stock owners of the derivative CCPs may have an incentive in competing with each other to economize on the risk management burdens that they put on their clearing members, that doesn't mean the clearing members are necessarily going to like it, because they're going to see risk management that they know is inadequate for themselves and assume, since every clearing member believes they're the smartest person in the world and the safest and the best risk managed, that it's going to be really bad for everybody else, and they're going to lose their margin and their default funds and so forth. The moral hazard here is subtle. It's not obvious to me that it's big. Okay. I already kind of said. So where's the problem? The problem here is the portion of the portfolio of the clearing member that cannot immediately be transferred to somebody else. Somebody else is going to have to be willing to take it, right? But for customer accounts, it's probably okay. It's the own account trades of the clearing member that are a problem, and my expert was rather persuasive that it's going to be difficult to get rid of that stuff. These are very illiquid contracts, really. You can try and hedge, but it's going to be imperfect. To actually unload the thing, they've got a complicated auction system set up with punishments for people who don't bid honestly. It's going to take a while, but the Fed can't help, because the only way in which the default funds and the margin is inadequate is if market prices have moved badly against the portfolio since the failed clearing member's last posting of margin, and now the central counterparty is having to post margin in their place, and they don't have enough wealth to do so. Coming to the Fed is not going to help. They're insolvent, right? The CCP is insolvent. They need capital injections. They do not need lender of last resort type loans for a temporary purpose. Okay, so once again, what you need here is a resolution authority. Once again, the regulators are regulating the size of the default fund, the initial margin, the variation margin practices, the assessments, the required assessments, the optimal assessments. with a point in mind beyond which the world is over, right? And there is nothing there, nothing to help the problem. The only thing that helps here, maybe a little bit, is that it's not like the trade has got to clear at T+3. It's that the central counterparty can't post margin. Now, you know, I hear that and I say, okay, well, you know, the world will go on. But somebody who lives in the derivatives markets thinks that 4 days is infinity and they're not getting their margin. I'm not sure the world would go on. It would be bad news. Okay. Okay. You know, Charlie explained the model well enough. The model's fine. You know, it's the sort of typical metaphor. It's got some special functional forms. It makes the point. You know, let me point out some things that, you know, Charlie sort of said, but not totally clearly. Okay, but I've kind of alluded to. CCPs are not a bank with mispriced debt financing due to expectations on the part of the debt holders that they're going to be rescued. That's where most of the moral hazard comes, right, in the banking world. It's the mispriced debt because of rescue expectations. The CCPs don't have a portfolio, except when the world is already a little bit on fire. Okay, so there's no debt mispricing. The moral hazard here is only coming from limited liability. Okay, that's a rather familiar problem. It's a problem. You know, you have to worry about it. But it's not like the bank situation. The paper seems to be written with a presumption that regulators will rescue too much unless the legislature punishes them. But in my observation, it's not obvious that the legislature is better at restraining itself from rescuing entities that are in trouble. Okay, so, you know, if one was going to think about this problem and one was going to think about pre-commitment, then if you want the regulators to do the right thing, you want the regulators to specify the point beyond which the entity will go into the hands of the resolution authority. And if the entity fails before that point, that is, that the default funds, the margining, and so forth are not adequate to handle the failure of the largest single clearing member or the two largest clearing members, then you punish the regulators. That's the way to get the regulators to make the safety be adequate. But you can't be safe against infinity, right? Or at least we think it's not efficient to do so. Okay. You know, the thing, yeah, it's a little confusing about role of law. It doesn't really seem like a law paper to me. It seems like a regulation paper. You know, it seems like a resolution paper. You know, again, just I can't resist. Sometimes one gets the impression that the legislature is the one who wants to pre-commit to only rescue at the optimal time. My observation is that at least in the United States, the legislature can't pre-commit to anything, right? They can't commit to actually provide resolution funds. They can't commit not to provide resolution funds. They can't commit not to create, you know, changes in the rules. So if you want commitment, you got to find a way to do it that doesn't require the legislature to either act or not act in the crisis situation. Okay, so I don't know what's on my last slide. All right. Okay, so my bottom line suggestion is, you know, when faced with a situation that's very damaging to society, governments will take action, but usually not efficiently. If we want to be more efficient, the thing to do is set up the system to deal with those bad situations so that the legislature doesn't have to take inefficient action. And what's required here to make that go is a resolution authority, not a lender of last resort. Thank you for your attention.
Thanks very much, Mark. Before we open it to the floor, Charlie, you want to take a minute for any comments?
Couple.
Use your microphone.
Couple of them. Thank you very much. Very useful. You are absolutely right. We do not make a clean enough. We're focusing on derivatives clearing rather than on clearing in general, and new issues arise, or separate issues arise in the second group, and we need to think about both of them rather than just one of them. The point about what the lender of last resort has been used very loosely throughout this conference, and so we were guilty of it as well in the process of writing this, and we probably need to.
It was okay with me once I heard the opening remarks, right? The reader of the paper is not necessarily going to hear those.
And so it makes sense to go ahead and clean up that language to make sure that other people do not fall into the same trap that you did. I agree with you very much on that. The question of the rule of law actually is going to be throwing part of the point of this, part of the theme on its head in this particular case. And I think it's an interesting and important one too, because in some respects we've been thinking of rule of law as being something that structures and keeps discretion out. But if that's where the lack of commitment lies itself, then maybe that's not the right way to think about things. For the point of view of the model, it doesn't really matter. The model is really about you've got one entity that's got some self-control and one entity that doesn't have some self-control. We can flip the names so that the model still goes through, but the interpretation does change in some dramatic ways, and I think that's an interesting thing for us to look at some more. Anyway, thank you.
I mean, if I could just follow up on that, I don't have a problem with asking the government to sort of pre-commit to how things are going to work in a bad situation in a way that we hope improves efficiency. But that pre-commitment is going to be much more credible if it's going to work.
Right.
Right. And what we have now won't work.
Yeah, that's right. You better pre-commit to things that actually have a stand a chance of actually being the thing that's going to be there. Yes.
Yeah.
Agreed.
Great. Let's open it up to the floor. Stein is the first one. Wait for the microphone, please, and identify yourself for the video, please.
So Stein Klaassen, Federal Reserve Board. I wonder whether the moral hazard problem is much more at a systemic level. So not having read the paper itself, so I'm free, I guess, to just venture what the paper could be about. In terms of that, we have some strategic complementarity in terms of the overall operation of derivative markets, going to certain types of tail risk that we really don't care about, and then exposed having the fire sales, and then for that reason we have the moral hazard problem, etc. Is that in some sense in the back of your mind, but the model seems to be more, okay, it's vis-a-vis kind of a typical bank moral hazard story of distorting your behavior as an individual vis-a-vis the operations.
We'll actually get a fight among the co-authors about that one, it turns out. In that there's disagreement among us about how important it is to worry about what I think of as that kind of systemic problem arises in these worlds from the possibility of standards that look good for the initial products that you've got being relaxed as new products come in, as they are right now. That is, the knowledge of backup, knowledge of safety of nets and things like that becomes a worry for what kinds of restrictions you will be putting onto the new products as they come in, compared to the history you've got for doing it correctly for the old ones. Again, I'm talking derivatives terms.
Yeah, collectively, the tail risk will be ignored.
Right.
But also the incentives are to ignore it.
Right.
Next one is Doug, and then Alan.
I have a question sort of following up on Mark's comment that there wasn't any rule for like a lender of last resort. Is there any notion in this setup? I actually don't understand CCPs well enough to know that there could be a point when they're still solvent, where people saw that they soon might not be solvent and stopped clearing through them, that could cause problems. So could there be some possibility of bringing in the lender of last resort at a point where solvency was still positive, and then somehow having some intervention at that to keep this from happening? Sort of, it's a little like what COCOs do in banks. I don't know. Just a question.
Yeah, I don't think so. Jenny?
I'm not sure of the exact details, but I believe there was some worry during the Barings crisis that perhaps Cymex might go under. I don't think the worry turned out to be something that materialized, but I think it was indeed a worry for other clearing members of Cymex.
And the point, if I'm understanding Doug's question, is that you might want to have required some sort of prophylactic measures once the worry arises, even before the real
Yeah,
problem.
when you're still solvent, but things are getting shaky, you're getting like it's like a minimum capital requirement.
Right.
So before you burn through the waterfall, you get lender of last resort in there, and there's some intervention to prevent you from doing something suboptimal at that point, socially bad.
The worry at that point becomes the extent to which these restrictions that you're putting on discourage the actual participation in
Right.
the market. So the examples that we've seen of trying to tighten up in the
Right.
before the end
Right.
actually are often counterproductive
Right.
because now people stop.
Right. Well, I was thinking like Jenny mentioned the Cymex thing. If people aren't dealing with this because they think Cymex might not be around in the next 3 days, they don't do any business for the last 3 days, and that could bring them down if there's not new business coming in.
Right.
So you can say anybody who comes in during these 3 days
Get special treatment.
gets special treatment financed by the lender of last resort, who takes maybe dilutes the claim of the pre-existing member capital. I don't know if you could do something like that.
I don't think that works
Mhm.
in the sense that, you know, the CCP's only got a portfolio
Mhm.
when one of the clearing members has failed,
Mhm.
and it takes over that clearing member's portfolio. So I suppose one could imagine that, you know, the resolution authority,
Mhm.
you know, comes in and says, okay, you know, we're worried that 3 more clearing members will fail, and so we're going to inject resources now while still forcing, you know, going down the waterfall. So in a sense, they would take a more senior position in losses. I mean, if any of these CCPs fail, then the world is over in the securities markets, right? I mean, you could not execute bond or stock cash market transactions if the trade clearers fail. And I think you probably could not execute, you know, the kinds of derivative transactions that clear through the derivatives counterparties. So you don't want them to fail.
I was just sort of guessing, given that they wrote this stuff into Dodd-Frank about lender of last resort. It seems
They had something in mind.
there must be some scenario where a lender of last resort would be good, unless we're using the
Maiden
definition of
lane
lender of
six.
last resort is a bailout by a different name.
Yeah, I mean, I don't think you could do a maiden lane in this situation.
Alan's next.
Follow up on that, or go back to where we were this morning. The point this morning was to very carefully distinguish between private losses, which are an acceptable part of the system, and public goods, that is, the failure of the payment system. Now, when I read your paper, I kept looking to see where do we get to a failure of the payment system from the failure of the individual institution. That's where any case, in my mind, any case, and I think in economics, any case for support has to come.
Well,
That is-
let me be a little controversial on that right before we go any further with it. If I think of a continuum between payments and liquidity and, I don't know, finance in general, derivative systems are basically, derivative systems now are basically about liquidity. Failure of liquidity there is a miniature version of failure of payments, seems to me. So it seems like that's the whatever argument you're going to make for the usefulness of a payment system is another argument to make for the usefulness of liquidity.
When a company, non-financial, fails, there's a failure of the payment system, but they can't pay their bills, so they close. I mean, that happens all the time. We see it now with a very big company that's failing and being taken over. That happens all the time.
Mhm.
But those are not public responsibilities. And it's hard for me to see how you get a public responsibility here. That is, do we have systems, for example, in the world where they don't have these CCPs?
Let me put my 2 cents in, and then let Charlie answer it. But imagine that there are a bunch of people in the world who have are extremely worried about keeping their risk positions limited, and they're using the CME as a way to keep those risk positions limited. And then suppose that the CME disappears, all of a sudden there are massive numbers of people in the world who thought they were protected, who now aren't protected, and start scrambling to protect themselves in one way or another. And that's all happening at the same time. That seems to me to be exactly the answer. That why is this a systemic event if this fails? Because people have been depending on it, and for a whole variety of positions, which if it disappeared sort of suddenly would cause people to have to readjust their positions all at the same time. So that seems to me to be the nature of the systemic event of its failure.
I don't see that as good enough. I mean, I would describe that as saying, you know, you made a mistake by depending upon an institution that failed. Now you fail. All right. What would be the difference if, for example, I said Warren Buffett had his money in the Continental Illinois Bank and the Continental Illinois Bank failed? Warren Buffett would lose a lot of money. But why is that a public problem?
Oh, well, okay. Well, let's push that the other way. There's no reason in particular that we should be doing the payment system publicly either. We could have a bunch of private banks running those payment systems, and they did a beautiful job doing them in many, many times. So let's go ahead and have the failure be a failure of the payment system. Now, who should have been relying on this particular bank to run that payment system? What a silly thing.
There's a difference, and the difference is the important difference. The failure of the payment system says we have contagion, right, which we cannot control. That is, our failure, because of the law is written that we don't have enough capital in the banking system. When one bank fails, it raises questions about the other banks, and people say, under the uncertain conditions that I'm living through, I'm not going to put my money in the bank. I mean, look what's going on in Greece. I mean, by the billions of dollars, people are saying, we don't have a clue as to how this thing is going to be resolved, so we're taking our money away. All right? That creates a public responsibility because we've created an institution which is causing spread damage to the whole system.
I agree that it's more severe in the case of the payment system. I don't see the difference I see a difference in degree, but not a difference in kind.
I
Yeah.
I think no, I think in the case of the derivatives exchanges, the mechanism by which society causes collateral to flow. As market prices move, right, one counterparty has to post collateral and one counterparty takes collateral. But if they failed, first of all, the collateral can't flow, and second of all, at least some of the margin that was in the margin accounts has disappeared. So there's contagion from the failure of the first clearing member to everybody who's participated in that market previously.
Certainly an interesting line of discussion where the question of identifying the society's externality, not just the particular market participants, is kind of an interesting element.
Absolutely.
Are there any other comments? Well, you know, this is one of the benefits of having a pre-conference that a lot of us got a chance to discuss the paper before. And actually, it's wonderfully coincidental because I was hoping to pick up a few minutes in the schedule. So maybe we should give Jenny a chance. Do you have any closing comments?
One more example. When Chicago stupidly flooded itself and they had to shut down the exchanges in 1992, there was measurable impact on trading elsewhere, stocks, bonds, etc. So if you do take out the derivatives system, it will affect the entire economy, not just people who are directly using the derivatives markets.
On that note, let's take a 15-minute break and we'll come back a little bit early. And then we'll all have an early start on the weekend. Thank you. I want to make a couple of announcements. The first announcement is, as Marianne just told me, we will be, if you're on the list of participants, you will get all of the papers and you will get a link to the video that will be probably put up also on the website along with the papers. And I hope all the discussants slides as well, if the discussants don't mind, as soon as possible. Good. So just make sure if you're a paper giver or a discussant, please make sure that Marianne has your current drafts of the paper. Those will go up on the website. Those will go to all the participants. We understand those are not the final drafts of the paper, and also the discussants, the slides too. So you'll all get that by email. I have a second announcement, which is on behalf of Alan Meltzer to thank Marianne Jacoby and her staff for a wonderful job arranging this. And it's now my pleasure to convene the last of the four papers. Oh, please, Alan. I'll say it so everyone can make sure to hear it. Please send your expenses to Marianne at the Hoover Institution. And a failure of Hoover to pay your expenses, I would not regard as a systemic risk, by the way. So don't think I'm going to bail them out in case they don't pay you. So again, our last paper of the day is lending of last resort is, as lending of last resort does, liquidity provision and interbank market functioning in the euro area. And Simone is going to present that.
Thank you, Charles, and thank you, Alan, for the invitation to speak among all these distinguished speakers. This is joint work with Carlos Garcia, Florian Heider, and Marie Herova, who are all at the ECB. And Marie was originally scheduled to speak, and unfortunately she cannot make it for personal reasons. And I'm very sorry for you, because she's a great speaker, a great presenter. So you have to bear with me again. The disclaimer is down there. These are own views. They do not necessarily represent those of the ECB. So the title of the paper wants to convey the idea that if you go through the general documentation of the ECB, you won't find the words lending of last resort. Still, we argue in the paper that the behavior of the ECB during the crisis was a de facto behavior as a lender of last resort. We also change a bit of gear with respect to the previous paper. This is going to be an empirical paper. And it wants to be a positive analysis rather than normative analysis, in the sense that we're not going to say whether the ECB did well or bad in acting as lender of last resort. We want to see how this de facto behavior affected the functioning of the interbank market in the euro area. So, as a motivation, this is on the horizontal axis. You have 2 years, 2007, 2008, and that's the beginning of the crisis. Before summer 2008, before summer 2007, you see there is a red line, which is the spread between the 3 months Euribor and 3 months Ionia swap rate. The Ionia is the equivalent of the Fed funds rate, the overnight interest rates. And this spread has been very, very low. It reflects basically counterparty risk in the interbank market. Has been very low, has been at this level for many years, since the beginning of the euro, essentially. And the vertical blue bars are the levels of excess liquidity. So how much liquidity the ECB provided in excess of the needs of the banking system. And you see that at the beginning, basically, there was no excess liquidity. The market was, the ECB was managing liquidity in such a way that the interest rate on the market was close to the desired rate. In summer 2007, you start to see the first sign of the crisis. We call that the time financial turmoil. And you see this spread, the red line, suddenly going up. So the counterparty risk has been priced up. And you also see some changes in the vertical bar, the blue bars. The supply of liquidity was still neutral, but the pattern in which we were injecting liquidity changed by providing more liquidity at the beginning of the maintenance period and then withdrawing at the end. And then the situation changed dramatically with the Lehman bankruptcy. You see the red line of the spread going all the way up, and you also see the blue bars going up. And what happened is that we changed the operational framework to a fixed rate full allotment. Basically, we provided to the banking system all the liquidity they needed, they wanted, in order to face the crisis. So, since October 2008, the ECB is providing basically unlimited liquidity to the banking system at its main refinancing operation rate. And this was an unprecedented and endogenous expansion of its balance sheet. And let me underline the word endogenous here because it's going to be key to the empirical part. Endogenous means that we just let the banks ask whatever they wanted. This supply of excess liquidity put downward pressure on money market rates, I was going to show you soon, and however, it's had significant variation over time and across countries in the euro area, which is another characteristic of the euro area crisis. And so what we want to do in this paper is, first of all, to understand the relationship between liquidity provision and lending of last resort function. And then we want to model explicitly the relationship between the endogenous provision of liquidity and the functioning of money markets. So before doing that, since we're in the US, let me give you a quick recap of the monetary policy implementation framework at the ECB, which is slightly different from the one of the Fed. And it rests on three building blocks. The first one is open market operations, and we do open market operations, we implement open market operations mainly using repos, repurchase agreements, where we lend central bank money against suitable collateral at the main refinancing operations rate. Then we have standing facilities, and since these open market operations are conducted at a weekly frequency, the standing facility are there to smooth high-frequency liquidity shocks. And we have two types of standing facility. One is the marginal lending facility, which is the equivalent of the discount window at the Fed. And banks can borrow extra liquidity but at a rate higher than at the MRO, which is the rate at which they can get the liquidity in the standard open market operations. And then you have a deposit facility where banks can deposit excess liquidity at a rate lower than the MRO rate. And the deposit facility didn't exist in the Federal Reserve System. It was introduced in 2008 during the crisis. The third building block are minimum reserves, and banks need to hold a minimum average of reserves at the ECB over the maintenance period, and these reserves, only the required reserves, are remunerated at the standard rate. Excess reserves are not remunerated, so you have the incentives for the bank either to trade these excess reserves on the money market or to deposit them with the ECB at the deposit facility rate, so at a lower rate than the MRO. And so the excess liquidity is going to be one of the key variables in the paper, and it just refers to the amount of the ECB liquidity allotted in excess of the liquidity needs of the whole banking system. You can think of this as the amount of liquidity which is in excess of the reserve requirement of the banking system. So what happened through time, through the crisis? Now the timeline starts from 2007 and goes up to the end of 2014. And what I plot here is the corridor system of the ECB. So you have the upper blue line is the marginal lending facility rate. The bottom light blue line is the deposit rate. And in the middle, you see a flat, piecewise flat line, which is the main refinancing operation rate. The red line is the interbank rate, the EONIA. And you see that at the beginning, before summer 2007, the ECB was able to keep the EONIA very close to the main policy rate. With the financial turmoil, the volatility increases, but still on average, we managed to keep the EONIA around the main refinancing rate. With the crisis, so at the vertical black line, we introduced this fixed rate full allotment. So we made the liquidity endogenous, and what happens is, well, we cut interest rates, but at the same time you see the red line dropping all the way down to the lower part of the corridor. I mean, those spikes are just nuisance related to end of maintenance period operations, which were discontinued, and you see that disappear all the spikes after 2012. But the point here is that with this change in provisional liquidity, with this fixed rate full allotment, what happened is that a lot of liquidity in excess went into the market, and this pushed interest rates down to the lower part of the corridor. So the ECB acted as a de facto lender of last resort, and one way to show this is to plot the time series of this excess liquidity. Again, think of excess liquidity as liquidity that we give in excess of the reserve requirements needs of the banking system. And you see that, again, before 2007, before summer 2007, excess liquidity was at zero. We're just managing market rates so that they were staying close to the policy rate. You see some volatility, and that was the period of the financial turmoil. And then after the red line, which is the Lehman default, we switched to this fixed rate full allotment. You see that excess liquidity started to go up to 250 billion. You read the amount on the vertical axis. And in the paper, and it oscillates around. In the paper, what we're going to do is to split the sample in two parts. Sorry. In two parts, and the second red line denotes the deterioration of the euro area sovereign debt crisis. So the first part we call the financial crisis, and was a period characterized by uncertainty all over the euro area countries and all over the banking system. In the second part, after end of 2011, we had a sovereign debt crisis where a lot of problems in the banking system concentrated in the peripheral countries. So what are the research questions that we ask in this paper? We want to know how the lending of last resort function impact the functioning of euro area interbank market. And we ask four types of questions. The first one is whether this ample excess liquidity is crowding out private demand in the money market, whether it can help to increase supply in some of the countries, and whether this impact is different across euro area countries, and whether this impact is different over time. In the financial crisis, the first part of the sample, or the sovereign debt crisis, the second part of the sample. There are a variety of papers that are related to our paper. A few of them on the lending of last resort. There are not too many related to the lending of last resort for the euro area, for reasons that there is not too much data available. One of them is the paper by Drexler, Marquez, and Schnabel, which is forthcoming in the Journal of Finance. There are some papers about the impact of ECB interventions and the function of market by Vieira-Lacharya and co-authors. And then there are a few more papers about the functioning of interbank market during crisis times. And here, one of the challenges to understand the functioning of the interbank market is data availability, and we are going to talk about that. So there are three empirical challenges that we need to overcome for this paper, and the first one is, as I mentioned, the availability of data. So interbank transactions are mostly over the counter, so there is no simple database that you can use and download all the transactions. So we had to go through the data available from the payment system. Our payment system is called Target2. It's the equivalent of the Fedwire in the US. And so one challenge is that in this interbank payment system, you have all the payments among banks, and you have to tease out of these payments which are interbank loans, which is what we are interested in this paper. And Florian and co-authors, Florian Scarlett and co-authors, have devoted a lot of efforts in analyzing this kind of data, and also to check the quality of the results that they get. So they tease out the interbank transaction using the full fine algorithm. It's basically matching one transaction of, say, 100 euros at day t with a similar transaction with the reverse sign at time t plus 1 plus of 100 euro plus a suitable interest rates. And unlike in the US, the full fine algorithm seems to work pretty well for the euro area data. The way they did that is to check with country-specific database where we know the identity of the banks and we know whether the transaction was an interbank loan. And this is what is shown in this chart. The blue line, you have the estimated, the inferred target to overnight transactions. In the red line, you have the official identified Spanish overnight transaction, and you see that the two lines coincide pretty much. The second important thing to take into account is that there is considerable heterogeneity over time and across countries. And you see this in this slide where we plot average interbank rate, overnight rate for 4 countries, which are the ones we use in the analysis: Greece, Italy, Spain, and Germany. And you see that in the first phase, which is what we call the financial crisis, there was not much dispersion across countries, was dispersion across time. And in the second phase of the sovereign crisis, you see dispersion also across countries, and this is something that you want to take into account in the analysis. The second challenge is how to identify whether you have demand and supply shift in this interbank market. And what we plot in the lower left chart is the loan rates and the loan volumes, interbank volumes for Germany. So when the borrower is a German bank, on the horizontal axis you have the quantities traded in the overnight market. On the vertical axis you have the rate paid. And so you see that the combination of prices and quantities here trace a positive relationship through the scatter plot. And the way to rationalize this is that you have to have some shift in demands relative to the supply over this period of time, because it's only by shifting the demand more than the supply that you have a positive correlation between price changes and quantity changes. Once you look at Greece, that's the same chart for Greece. You see that the relationship is completely different. You don't have any more a positive relationship among the scatter plot. If anything, it's a negative relationship. So you need to rationalize this by looking both at a supply and a demand shift. The third challenge is, as I mentioned at the beginning, is that this excess liquidity is endogenous. What does it mean? It means that the incentives for banks to come to the ECB and ask for more or less liquidity depends on the state of functioning of the money markets. When money market rates are very low, the incentives for banks is to try to get as much liquidity as possible from the market, and so they will ask less liquidity from the ECB. When money market rates are high, the incentives are for banks to come to the ECB, and this would increase the overall supply of liquidity. So in the empirical analysis, you want to take this into account. So how can we identify exogenous liquidity shocks? And we do that by exploiting the institutional setting of the ECB operational framework. And remember that we have this liquidity operation on a weekly frequency. The liquidity is asked by banks on a Tuesday, and that's the first day over this simple chart. And then it's allotted on the Wednesday, and then you have a trading in the interbank market, a daily trading, that goes up until the next Tuesday, which is when you allot the next liquidity. So the point here is that since the liquidity is allotted on Wednesday, it cannot possibly be affected by the trading in the interbank market, which occurs temporarily during the week, so after the liquidity has been allotted. So in practice, how do we do that? So translation of what I just said is that this week's shocks to the trading cannot affect this week's shocks to the excess liquidity because of a temporal mismatch. One thing you have to do is to control for bank risk, because bank risk is arguably driving the amount of liquidity that banks ask. And so the framework we use is a structural vector autoregression, where the dependent variable, the Z, are the excess liquidity, the quantities traded in the interbank market, in the overnight market, and the prices, the rates at which they trade. We also control for bank risk as an exogenous variable. And how do we identify the exogenous shocks? Where we use a simple Cholesky decomposition, where we put the excess liquidity at the top of the Z matrix. We don't care about identifying quantity and prices because we are going to study the impact of shock to excess liquidity on quantity and prices. So we don't care about the ordering of the other two. So then the data set is combining three types of data, to sum up. The first one is interbank data, which is derived from the confidential target to interbank transaction level data. And we volume weight interest rates by the quantities traded in the market. And then we use just total volume over the week. The second type of data is excess liquidity outstanding at the Eurosystem level. Again, this excess liquidity is the amount of liquidity in excess of the needs of the banking system. And the third type of data is for bank risk. So in the baseline specification, we control for bank risk by CDS. We average them by country. But then we have a series of robustness checks upon suggestion of Philip Schnabel, who was our referee last time. The sample is, again, weekly data. It runs from October 15th, which is when we introduced the fixed rate full allotment, 2008, until June 10, 2014. June 10 is the date in which we introduced negative deposit rates. And we didn't want these negative rates to affect our estimates, so we left that part out of the sample. And we're going to have to estimate this VAR into subsamples. The first one is before July 13, 2011, which is the financial crisis. And the second is after July 13, 2011, which is the sovereign debt crisis. Some summary statistics about this data before, in the first phase, in the financial crisis, the first column, and the sovereign debt crisis, the second column. You see the excess liquidity in the euro area, it's the first line, more than doubles in the second part of the crisis. You also see that bank CDS increases considerably, almost doubles. But then if you look at Germany, and interbank volume decreases, and interbank rate spreads slightly decrease. If you look at Germany, you see that the bank CDS is roughly the same. You don't have much of a problem of a banking system in Germany between the two crises. If you look at Greece instead, you see that the CDS almost triples, and you have a big increase in the CDS of the bank also for Italy and Spain. So these summary statistics already show you that there are the two type of crises were quite different in terms of underlying risk. And that's also, an important point that we want to make to control for bank risk in order to have the identification of the exogenous shock of excess liquidity as clean as possible. So now I'm going to show you, these are the main results of the paper, the main empirical results. I'm going to show you impulse response functions. I have 5 of these charts. This is for the euro area, then you have for Germany, Italy, Spain, and Greece. And you have 2 panels. The upper panel is the financial crisis. The lower panel is the sovereign debt crisis, the euro area sovereign debt crisis. And you have 2 columns. On the left, you have the impact on overnight interest rates. On the right column, you have the impact on volumes. And these are the impulse responses, so how market react to an exogenous shocks to excess liquidity. You have an exogenous shocks of around 40 billion to excess liquidity, the exogeneity being identified as I show you in the VAR. We want to trace out how this is going to be transmitted through the euro area interbank market. And so let's start with the upper panel, so the financial crisis. You see that these shocks, a sudden increase and an expected increase in excess liquidity is going to drive down interest rates, overnight interest rates, and overnight transactions volumes in the euro area money market overall. So how do you interpret this? Well, this can be interpreted as a crowd out of demand in the money market. You have both prices and quantities going down. It can be rationalized as a sudden increase, an expected increase in excess liquidity is crowding out part of the demand in the money market. The second part of the crisis is the sovereign debt crisis, the lower panel. You see it's quite different. There seems to be no impact on the interest rate. There is an impact on the amount of volumes. And one way to rationalize this is again a crowd out of demand in a part in which the supply of funds was relatively flat, because there was a period in which you have massive excess liquidity and interest rates were all the way down to the corridor. If you look at Germany, the situation is very similar to the whole euro area. Maybe it's not surprising because we're weighting by volumes, and since Germany is relatively bigger to the other countries, you get very similar results. Again, sudden unexpected shocks, positive shock to excess liquidity increases is driving down interest rates and volumes in the money market, in the financial crisis, the top panel. And in the euro area sovereign debt crisis had an impact only on volumes. And this can be rationalized again as increase in excess liquidity as crowding out demand in the interbank market. Things start to be a bit different once you move to the Italian case. And in the first phase of the crisis, the results are again similar. A shock is having an impact on interest rates and on volumes, a negative impact. Again, a crowd out of demand. But in the second phase of the crisis, it's quite different, because the shock to excess liquidity is having a negative impact on interest rates, but no impact on volumes. So one way to rationalize this result is that you do have a crowd out in demand, but you also have a crowding in supply. And one of the things we are doing now, is to understand whether this crowding in supply is coming from cross-border loans from German banks who are awash with cash. That is something we're trying to tease out now. The results for Spain are similar in the first phase of the crisis. In the second, in the sovereign debt crisis, you don't have much of an impact. You don't have much of an impact. The trading volumes in the Spanish market, in the Spanish overnight market, was very limited during the sovereign debt crisis, and that explains the fact that we don't find much. And similar results hold for Greece, where in the first phase you have an impact of excess liquidity on interbank rates, but not on volumes, and which is consistent with a crowd out of demand and crowding in supply. But you have basically no action in the sovereign debt crisis. Again, there was a period in which there was basically no much trading in the Greek interbank market due to significant doubts about counterparty viability. Oops, one too much. Then what we do in the paper, and that was partly inspired by also by the comments of Philip last time, we do a series of robustness exercises until now, we have done a sample split according to just a time dimension. So we split in the summer, at the end of 2011, because that's when the euro area and the crisis really started to deteriorate at worrisome levels. You can also think of splitting the sample by looking at the levels of excess liquidity, and we do that by taking the sample in periods in which the excess liquidity was above 200 billion, excess liquidity below 200 billion. We do the whole exercise and you get very similar, qualitatively similar results. We also have a series of control for alternative control for bank risk, which we think is an important variable you want to control for in this kind of framework. We use EDF, we use sovereign CDS for the country, and again, results are similar. And one last part that we're working on, and we think it can be shed interesting light in the functioning of cross-border interbank functioning, is to distinguish between what are domestic and cross-border interbank transactions. So especially in the case of Italy, we want to, or Spain, we want to know how much of this crowding in supply is driven by loans by German banks that are willing to extend their funds to Italian banks. And that, of course, would be very important for understanding the function of the market. So going back to the question I raised at the beginning, we can now give explicit answers. So the first one was whether ample excess liquidity is crowding out demand. Yes, and this was especially true during the financial crisis, so the first phase of the first part of the sample. Can this shock to excess liquidity increase the supply of funds in the interbank market? And again, there seems to be evidence, at least in stressed countries, that this can happen. Is the impact different across euro countries? And the answer here is again a clear yes. We see there is considerable heterogeneity, and we see very different behavior, very different impulse responses, especially in the sovereign debt crisis in the peripheral countries. Is this impact different over time? Again, yes. The impulse responses are very different between the two periods, and the ample liquidity has crowded out demand in the interbank markets, but it seems to have led to more lending to banks in the stressed countries. So to conclude, the last slide. Oops. Can you press? Okay, thanks. So I think we can agree that the ECB acted as a de facto lender of last resort in the euro area banking system, in the sense that it provided ample liquidity to the banking system. Remember that all these liquidity operations are against collateral, so it was collateralized lending to the whole banking system. What we did in this paper is to use a novel data set, this target2, to shed light how this supply of liquidity is affecting the functioning of the interbank market. I told you about the identification, which is through the timing and exploited the institutional feature of the operational framework of the ECB. And the last point is that this paper shows the benefit in terms of crowding of supply of these operations, but also the limits in terms of crowd out demand in some of the samples. Thank you for your attention.
Thank you. And our discussant is Krista Schwartz.
So, thank you very much for having me. I'm having a lot of fun today, and I think this is a very interesting topic, and this was an interesting paper to take a look at. So I'm delighted to be here. I think Simone did a fantastic job in presenting the contents of the paper, and so I'll move pretty quickly through just a brief summary of what they have looked at. So, as Simone mentioned, the ECB has shifted the way in which it's done monetary policy pretty dramatically in the last 6 years. So traditionally, they had operated with something they referred to as a structural liquidity deficit. And what that means is the operations, the funding operations, would provide a pre-specified quantity to banks, which would, as close as they could get on average over the maintenance period, then allow banks to precisely meet their reserve requirements. And then in the crisis in October 2008, the ECB started to switch completely to a fixed rate operation. So the historical thing is to have a competitive rate and full allotment, which means that the quantity not only was it not pre-specified, but it could be effectively endogenously chosen by banks because they could have as much as they were willing to bid for at that fixed rate, the policy rate. Now, as you can imagine, this shift in operational way of allocating liquidity and in policy caused a much greater amount of variation in excess liquidity. And so excess liquidity, the definition of that is what banks are holding in funds above and beyond what their statutory requirements are. So you can see this is just a picture. Simone had one very similar from 2008 to present. It varies from about 0 in excess reserves to almost €1 trillion here. Now the main question that they are asking is what effect did this variation in levels of excess liquidity, what effect did these liquidity shocks have on the unsecured interbank market? So the interbank market that exists outside of the operations. Oh, sorry. And specifically, they want to know the effects on prices or interest rates of unsecured transactions, unsecured interbank transactions, and on quantities or trading volumes. And they have this great unique data set, Target 2. This is effectively the equivalent of Fedwire, their payment system. And so, as Simone mentioned, they use the algorithm that Furfine used on Fedwire. They apply that to Target 2, and they infer the rates and quantities of overnight unsecured transactions. Now, they break out the results in a few different dimensions. First, they look cross-sectionally at the country of the bank where they're resident. They consider that to be the borrower, where the borrower is resident, they consider that to be their home country. They also look over 2 subsamples of their sample, their data sample, and they also break it out with some threshold of a liquidity limit. So above 200 billion euros, the ECB considers this to be unusual amounts of excess liquidity, and so they look above and below that threshold. Now, there's some discussion of the interpretation of these results, and they tease out the effects on supply and demand by interpreting it as if prices are coming down or interest rates are coming down concurrently with transaction volumes coming down, then this is interpreted to be shifting or moving down the supply curve or a shift inward in demand. And then similarly, if price and quantity are moving in opposite directions, that is interpreted to be primarily affecting supply. Oops. Now, the approach that they take to conduct this analysis is they use a vector autoregression whereby they're recursively ordering these variables, and the first variable is excess liquidity. This makes a lot of sense, and it's motivated by this neat fact that Indeed, the operations occur weekly, and so in between those operations, the quantity of excess liquidity is fixed, and that clearly can't be affected contemporaneously by prices or quantities. Now, bank CDS are included in other expected default frequencies as well in robustness as a variable describing bank credit risk, and these are considered to be exogenous. Now, the main result is that in the first half of the sample period from 08 to 2011, they find that for the euro area as a whole, prices and quantities both tend to come down, and they interpret then that as a positive shock to excess liquidity, primarily affecting demand for the euro area in aggregate. When they look at Italy and Germany specifically, they find very similar results for the first half of the sample period. In Spain and Greece, then, they find that volume responds but not rates. And then in the debt crisis subsample, the results are a bit more mixed. There's generally much less significance, and the results are quite small. So I think these are interesting things to look at and very interesting results. There are just a few things that I might point out a bit more. This is a picture that I've taken directly from the paper, where it shows the effect of a $38 billion positive shock of excess liquidity to the euro area in the first half of the sample period. This is a shock, the impulse response to volume, transaction volume. And you can see that transaction volumes do come down, and it is significant, but it's about 7-8 billion in total quantity. So relative to the 38 billion shock in excess liquidity, that seems like a numerically very small response. And so I would say that any crowding out effect that these liquidity shocks have is indeed it's a small fraction of the excess liquidity shock to start with. Then looking at how long this persists, after about 12 weeks or so, it completely vanishes, and so these shocks also don't seem to be terribly persistent. Now again, looking at this picture of the ECB's level of excess liquidity, the excess liquidity in the whole euro system, the thing that really strikes me most about this picture is that massive run-up in late 2011, early 2012. And that happened coincident with a couple of special long-term refinancing operations that had a 3-year maturity. And these were sort of unusual and unique. A 3-year maturity is the longest maturity that the ECB's ever had for operations. And they were both subscribed to the tune of about 500 billion euros, so they were also incredibly large. And then we have nearly as sharp of a decline following that about a year later as these are repaid early. Now these LTROs did not just, they weren't sort of fabricated for no reason or just for fun. This was against the backdrop of very high government debt yields and banks facing possible capital losses. And so at the time, it's possible that indeed the ECB would have thought their ideal policy prescription might be aggressive quantitative easing and perhaps a bank bailout or capital infusion to the banks. Now, politically, for the euro area at that time, this would be considered to be mission impossible. So if you can't actually have the type of operation that you want, then you might as well synthetically replicate it, and that's the next best thing. So the way to do that, and this is how I think of these long-term refinancing operations, the 3-year operations, first you lend money to banks at short rates for a period of, say, 3 years or so, and then you encourage them to buy higher yielding government debt, which effectively allows them to earn the seniorage spread between the higher yielding debt and that short funding rate, giving them an effective capital infusion, and it increases demand for this government debt as well, which then is QE-esque. Now, that's all good and fine. Think of that what you may. The reason I'm pointing this out is that I think that that particular type of excess liquidity provision through these long-term refinancing operations is just different in nature from the other excess liquidity provision that the ECB was providing over that 6-year period. And so I think it would be important to know, if you redid these results, say stripping out the effect of these particular long-term refinancing operations, how much does that influence results? Now, the authors do sort of a rough proxy of what I'm suggesting by looking at quantities that were excess liquidity quantities that were above 200 billion euros and those that are below. However, if you look at the data, the number of observations that end up being above 200 billion euros, it's about half of the observations. And so it's not being as precise as I think it perhaps could be or should be to really identify what's happening here and what is where the results are coming from. Now, with regard to the identification, as I mentioned before, it's a vector autoregression, has recursive ordering, excess liquidity is first. That's a very clever identification, and I like the fact that that's harnessing sort of that fact that ECB operations are weekly, and therefore that price and quantity can't contemporaneously affect excess liquidity. The way the paper is written, and I'm not sure if this is perhaps a misinterpretation given Simone's presentation, but it seems as though quantity is ordered second and price is ordered third. Now, this assumption, or this assumes that quantity can contemporaneously affect price, and price can't have the same effect on quantity. And there's no discussion as to why that particular ordering would be chosen. And so I think that a first pass to sort of see how much of an effect this has is to check the sensitivity to this ordering. That doesn't solve the problem, though, that price and quantity really they occur simultaneously. And so what I would suggest is to restrict the ordering such that excess liquidity remains first. That is uncontroversial. And then to leave quantity and price free from ordering, and there's a technology to do that. With regards to bank risk, this is considered to be exogenous as a control in this analysis. And again, I think this comes back to perhaps most importantly the LTROs, that if you think of that example as some sort of backdoor funding or capital injection to the banks, then that shows how the refinancing operations or even the announcement of them has a direct effect on the creditworthiness of these banks. Another assumption that the paper makes is that there is a linear relationship amongst these variables. And to me, just thinking through it intuitively, that seems doubtful. If I were to give banks, say, 100 billion euros in excess of what they need to meet their reserve requirements, I think rates would probably soften quite a bit. And they'd probably get close to that deposit facility level. Why would they lend in the market at a rate lower than what they can get from the ECB? If I give them, say, 1 trillion euros in addition to that first 100 billion, what's going to happen? I'm not going to get much bang for my buck because rates are already as low as they can go. They're at the floor. So to see if that intuition holds in the data, I've plotted here. This is the Ionia rate, the market-driven interbank rate, minus the deposit facility, the ECB's deposit facility rate. And this is against excess liquidity on the x-axis. And you can see the first, say, 150 billion or so in excess liquidity, that definitely brings rates down. It definitely causes banks to price this interbank liquidity close to that deposit facility rate. And then anything above and beyond that, well, rates pretty much stay at that low level where they fell with the first couple hundred billion. Now, I think this is a very interesting work. I think it's an important research question. We should know what the effects of all this excess liquidity is. It's not just a phenomenon in the euro area. And so I think it's worth possibly expanding the discussion of policy results. Right now, the paper is very much focused on unsecured interbank markets. And as we just saw, there's sort of a limit to where those rates can go, or to what effect excess liquidity can have on those rates, given the corridor system of the ECB that keeps rates contained in those bounds. And so I think it might be interesting to look at other short-term rates. So for instance, repo rates aren't constrained in the same way. The ECB operations, those are conducted collateralized, and so that seems like a very natural fit. Lending quantities from banks, that's also something we need to understand what prompts those. That might be more difficult to get a handle on. And then another thought is, what if we just look at another asset class altogether and see if there's some sort of relationship there? So I went ahead and plotted. This is a picture of Eurodollar, the Eurodollar exchange rate in red, and it's plotted alongside of that level of excess liquidity in blue that we saw before. And you can see that as levels of excess liquidity increase, the euro weakens relative to the dollar. And given how notoriously difficult it is to see some relationship contemporaneously with exchange rates, I was actually quite surprised to find that when I ran this in first differences, monthly first differences, there was a significant negative correlation. So that suggests that excess liquidity might be having some exchange rate effect too. Now, I always like to bring things back home, so what about us? What about the US? What does this mean for me? Well, if I compare the situation in the euro area to what we have in the Fed system, the Fed right now has about $3 trillion worth of excess liquidity. So this is $3 trillion that banks are holding above and beyond what they need to based on their requirements. In the euro area, they have a lot relative to what they've had historically, but relative to the US, really it's kind of a drop in the bucket. Now that said, the US has had a few rounds of quantitative easing since 2009, and so excess reserves have grown steadily over that period. Though, during the last several years, the Fed funds rate has remained stable around 11 basis points, despite this rise in excess liquidity. Transaction volumes in the Fed funds market, which I'm showing here, these have come down. There may be many things, and lots of people have tried to figure out what's driving this. There could be many things affecting it, but it does look like it's coincident to some degree with QE rounds and with the growth of excess liquidity in the Fed system. And so these two facts together then are consistent with a story that excess liquidity has a nonlinear effect on prices or on interest rates in the interbank market, and that it causes transaction volumes to fall. So the implication that I see from this is that indeed we're in the US right now very focused on a normalization to policy and raising rates at some point in the future. And so I think it will be possible for the Fed to get a handle and to be able to control short rates, but I think it will, or this suggests that it will require massive amounts of reverse repos. And what that's effectively doing then, it's effectively having the Fed be this risk-free deposit institution, which you could characterize as entering a narrow bank regime for the Fed. Oops. So in conclusion, I thought this was a great paper. I think it's very important to wrap our heads around the effects of excess liquidity, given that we've, produced so much of it. The title uses lender of last resort twice in one sentence, so you can't get more appropriate than that. In the environment that we're in right now, ECB is about to kick off QE, and the Fed is moving toward normalization of policy and is going to need to control rates and move them up at some point in the near future. And so I think the importance of the implications of excess liquidity are only going to grow in the future. Thank you.
I will just make one comment before I let Simone respond, which is, of course, they don't have to use so much repo if they raise the reserve requirement substantially. some of us think that that might be a good idea. And it may be something that would be prudentially useful too. But I'll resist any further comment on that. Simona, you want to respond?
Yeah, thanks a lot, Krista, for a very thoughtful discussion. I really appreciate that. Let me give credit about the title to Charles. It's coming from him. Lending of last resort is as lending of last resort. That's actually the first time I read it. I thought it was a typo, but then they explained what it actually means, and I think it's really fitting the content of the paper. I would like to make one comment about the relationship with QE, which you raised in your discussion, and I think there is a substantial difference between the way we implement monetary policy at the ECB and the way they've done it at the Fed. And by implementing monetary policy with these repos, what happened is that, as I mentioned in the presentation, that all this liquidity was endogenous and was partly driven by the overall risk of the banking system. And so the balance sheet of the ECB expanded at the height of the crisis, and as the crisis subsumed, you see that the balance sheet shrank again. And that's what you see after these 2-3 years LTROs, when that was after Draghi mentioned the famous sentence, whatever it takes, they really took a lot of risk out of the system, and you see the balance sheet of the ECB shrinking dramatically. Now we're embarking in a full-blown QE, so we have outright purchases of bonds. You will see the balance sheet increasing again. It's a completely different dynamics, because until the increase of the balance sheet was due to repos, this excess liquidity was endogenous. So there was this relationship between money market functioning and excess liquidity back and forth. Now that the excess liquidity is going to be injected through outright purchases, it's going to be completely exogenous. And so you will see that there is no more dynamics between excess liquidity and money market functioning. My projection is that as excess liquidity increases again, you will see rates, interbank rates, dropping to the lower part of the corridor and volumes dropping significantly. And incidentally, one of the internal documents, what we show is that there was also considerable correlation between the size of the balance sheet of the central bank, of the ECB, and the disanchoring of medium-term inflation expectations, which can also explain part your correlation, inverse correlation with the exchange rate. In an environment of zero lower bound, the way you can have expansion in monetary policies by expanding the balance sheet, and that is related to the point you were making. On the nonlinear effect, that's another point I want to underline. Actually, the chart you show a scatter plot between the on-year rate and the excess liquidity, and you show that it has this L shape, right? And you see that we spend a lot of time trying to identify where this curvature occurs. You see that the curvature occurs between 150 and 200 billion. And that was the inspiration for our robustness check in the analysis to use as a threshold the 200 billion, because that's exactly when you have a change in the shape of the relationship. And that's one way to capture nonlinearities. The other way is to have separate estimation across countries, because you have this other type of heterogeneity. I have other points, but we can discuss them later.
Why don't we open it up to questions from the floor? John?
So Krista mentioned this inducement that the ECB provided for the banks to hold sovereign bonds so that they could get the spread. So one cynical view is that they were simply pushing the crisis further down, that if these were bonds of countries like Greece, you were creating another kind of crisis down the road that maybe some other body like the EU might have to deal with. by providing liquidity to these bonds that may not have been provided absent this sort of inducement.
Let me just piggyback on that comment, which I like so much, because what Krista said, if I interpreted her right, is this is like a way to create a recapitalization of the banking system through a sort of excessive spread that you're giving them through this sort of unusual long-term credit. So it should be this separate and very different kind of effect. And then, and John's pointing out, it's also a subsidy to the sovereigns because it's giving a captive sort of demand to them. And so it kills two birds with one stone.
Well, actually, there are papers by Acharya that show that banks did quite some carry trade, and it's not clear it was the intention of the ECB to do that. You know, just play according to the rules. We had a collateral framework, and as long as the banks were bringing assets that were eligible, we were willing to extend the loans. So one main concern was that you know, the discussion at the CB at the time is that we wanted to make sure that the banking system didn't have any liquidity issues, so that they could extend loans to the economy. That's what we were trying to do, and you know, we realized that some of the banks were just using this liquidity to do this kind of carry trade. And then there was a second wave of long-term operations, which actually were launched about 1 year ago. They're called targeted long-term refinancing operations, whose maturity is actually 4 years, even longer. But now the idea was to tie this liquidity to an increase in loans. That banks could show that in their balance sheet they have shown that they have increase in loans, then they could ask for liquidity against this increase in loans. And you know, that's just to show that it was a concern that was very much felt and very much discussed within the central bank.
The issues were converting what may have been a liquidity crisis into an insolvency crisis, just pushing it down the road. And then, especially since the risk weights were the same, regardless of whether it was German sovereign debt or Greek sovereign debt, right? So in that case, to the extent that the spreads were higher, you had a perverse incentive to invest in the riskiest sovereigns with the biggest spreads.
Well, but then some investors were burned, right? With Greece, they didn't really get all the money back, so there was some risk. And again, we lent only against solvent banks, at least according to the definition of the supervisor at the time, and against good collateral. And you know, ex post, we didn't lose a single euro. We made actually a lot of profits out of this liquidity operations.
But the ECB got all their money back on the Greek debt, which is part of the reason that nothing was lost, right?
So far, yes.
I want to also comment that Mario Draghi actually wears two hats. In addition to being head of the ECB, he's head of the European Systemic Risk Board, and as such, he could have decided to been part of a group wanting to raise the risk weights on sovereign debt. So it's not that the ECB was or at least that its leadership was somehow unable to think about these, and I was involved in that discussion and can tell you that people were very aggressively pointing out that this was a time when the risk weights, we should start thinking about risk weights for sovereign debts in Europe. And of course, the ESRB is the entity, but that's run by, to a large extent, the central banks and the sovereigns, and they have no interest in that. So I don't think we can exculpate the ECB as human beings, as people, maybe as an institution, but the actual people sitting in the room who are making these decisions, I think very much are intentionally deciding that they want to push some subsidy into the sovereign market. Anyway, that's my 2 cents. Stein.
Stijn Claessens. So it's still related to the same point because you mentioned that the supply shifted outwards in some countries, periphery countries. What's your interpretation for that story, if it isn't the story that Anjan and Charlie are pushing here in terms of supporting the banking system and that way facilitating a more better supply? Is there something else you had in mind? I didn't hear you say explicitly. In terms of methodology, I was surprised you didn't use the OMT as a way of classifying the periods before and after, because it's changed so much, the whole perception overall. So I would have thought that was also a nice identification for you to look before and after. And lastly, you mentioned something on foreign banks and cross-border. Do you have in mind the cross-border of Deutsche Bank or whoever lending to Spain in terms of non-financial corporates, or are you thinking about lending to Spanish banks? Or do you also have in mind the operation of Deutsche Bank in Spain in terms of its liquidity vis-a-vis the rest? Because I think that would give you quite a lot of identification in terms of where the risks were coming. Was the country risk, was the sovereign risk, or was the bank risk? And maybe you can then tease out a little bit more what the channels are that are going on at this point.
Yeah, so the first and last point, I would bring them together. So we are looking at only interbank loans. So it's not loans from banks to private corporations. And that's actually what we're trying to tease out with this Furfine algorithm from the target to data. And so that's one question we are actually trying to look into. How is this possible that you have this shift in supply? And one of the ideas we have in mind is that, you know, once German banks are very long in liquidity, they have the outside option of depositing at the ECB at the deposit rate, or once all the German banks are long, they cannot trade among themselves anymore because they don't need liquidity. So they can look out for sound counterparties across border in Italy or in Spain. That's the idea. And on the OMT, so the OMT definitely was a milestone in terms of turning the sovereign debt crisis, but you cannot use in our framework because what is really driving the dynamics are the levels of excess liquidity, and so the OMT came after the three LTRO operations, and you see that that's when the excess liquidity start to come down. But as long as the money market is flooded with excess liquidity, we have little transactions and you have very different dynamics. If you use the OMT, you would get very distorted estimates.
Further comments?
So I guess I just had one sort of perhaps follow-up interpretation. I think to Anjan's question, which was then repeated a couple times. I think it's true you could think of sort of that period as a shift from a liquidity issue to a credit issue. It's possible also that you could think of the, say, countries that had sort of sovereign debt yields that were rising, making their fiscal positions worse when they perhaps wouldn't have otherwise had, you know, a difficult time financing that debt. And so the way I thought of it, at least at the time, was shifting from a bad equilibrium when yields are rising perhaps more aggressively than they should be, and it's sort of this adverse feedback loop between that and the government's fiscal position, moving it to a good equilibrium whereby the yields are lower, now they can handle it, and there's not a problem anymore. Obviously for Greece in particular, that wasn't the story, but perhaps for Italy or Spain, that could be an interpretation as well.
Well, not seeing any further discussion, I think this might be a good time for us to wrap up. I will take this opportunity once again to thank the people at Hoover for helping us run the conference. Thank the authors and the discussants. Please make sure that you all send everything to Marianne. The expenses as well as the comments. And we will be getting back to authors very soon with reminders about timing and all the rest of it for the final production of the volume. Alan, do you have anything you want to say? I think